Hi friends, welcome to the channel JAIIB and CAIIB Made Simple. Do you want to revise the entire BFM Module D in just a single video? And not only that, there is a new way, there is a new technique to help you cover the entire content in diagram and flowchart manner. You are at the right place, because in this particular video we are going to cover from unit 26 to unit 31 in the most lucid manner. I will explain the concept like this kind of diagram, which will help you retain the concept for a longer time, and you will be able to understand each and every concept. And just after going through this video, if you solve MCQ, you will feel 100% confident to solve those MCQ. So take my word for granted, watch this video. It will hardly be 2 to 2.5 hours, and I guarantee if you go through the entire video at once, you will feel more confident than ever before, because this is a new way of learning, right? This is called revolution in the learning of BFM. Why? Because every concept have been explained in the form of flowcharts and diagram, and if you this PDF will surely help. Such video will help you in revising the entire content. We are covering only thing that matters from the examination point of view. We have analyzed the last 5-year paper. Based on that, what I am providing you. So let's get started with our first unit, that is our unit number 26, and the chapter name, as you can see, is the bank balance sheet structure and the requirement. So let's get started. So friends, have you ever wondered how bank manage their money? Just like any business, bank maintain a balance sheet. What is a balance sheet? Basically, it is a kind of financial snapshot, right? It is a kind of financial snapshot that shows where their money come from and where it goes. But unlike regular company, bank follow a strict legal guideline, right, when preparing their balance sheet. Let's break it down in the simplest way possible. Every bank balance sheet has two key parts. One is called source of fund and other is called application of fund. So let me show you the two parts. Source, if you look into the source of fund, this is where bank gets its money. It includes capital. Capital means the money invested by the owner or shareholder. Then come reserves, means the portion of profit set aside for future need. Then come deposit, means the money customer keep in their saving, current or fixed deposit account. Then comes borrowing. Borrowing, it means loan taken by the bank from any other financial institutions. Then comes other liability, which means any additional obligation the bank has to fulfill. So these things comprises from where the bank get it money. Then on the other side, if you look at the application of fund, so application of fund means that where the bank utilize the money. So where bank use this fund, this is where the application of fund comes into picture. This is how the bank utilizes money. First of all, cash in hand and balance with RBI. So money physically held by the bank and reserve kept with the RBI. Then comes that money and call and short notice. That is called then balance with other bank, which means money in other bank and for liquidity. Then come investment. Investment. So basically government bonds, securities, and other investment. Then come advance. Advance means loan given to business and individual. Then come fixed asset, means bank building, ATMs, infrastructure, other asset, miscellaneous item. But wait, bank can't prepare balance sheet as they wish, right? So basically they are a strict legal requirement, right? Under section 29, let me move to the right side. So you can see under section 29 of the banking regulation in 1949, right? All commercial bank must prepare a balance sheet along with a profit and loss account. So they need to prepare balance sheet also and profit and loss account also. This is mandatory, and you must know, as per the government notification, let me show you, as per the government notification, here you can see 240E, right? As per the government notification 240E 26 March 1992, right? Bank follow a standardized format, which is set by the Gazette of India, a standardized format, ensuring uniformity across the industry. Now when do bank finalize and report this financial data? So it happened on the last working day. It happened on the last working day of the financial year, right? This ensures transparency and accountability. So to conclude, bank balance sheet is not just a financial document. It is a structured, legally regulated report that reflects the bank financial health. In the next section, we will deep dive into it. Friends, now let's look at the asset liability management objective and process. In this particular slide, you can see every aspect of ALM, and this will help you in the final revision before the examination. Suppose one day before the BFM examination, you see the BFM book, it almost 900 pages are there, 800, 700 pages are there. How you can cover the entire in just one day? Then you will need short notes, and this is the pictorial format. This is the most effective format of learning the thing, right? And this is included in our crash course. For each and every subjects of CAIIB, we have such kind of slides available where everything is represented in flowcharts, mind map, so that you can easily retain it for the long time. If you want to get more detail regarding it, feel free to WhatsApp me on this particular number, and in the description section of this video you can get more detail. So let's get started with the ALM. Have you ever thought how bank maintain a perfect balance between what they own and what they owe? It's like walking a financial tightrope. And this balancing act is called ALM, that is called asset liability management. But why is it so important? Let's break it down in the simplest way. The main goal of ALM is simple: to enhance the asset quality, right? To measure the risk and to effectively manage them across the balance sheet. That is the role of ALM. In other words, bank need to ensure that they invest wisely, they control the risk and keep a steady financial position at all the time. If we look at the core aim of ALM, if we just look at the what is the core aim of this asset liability management, in the right side you can see that. But how does ALM work in practice? Well, bank need to manage several factors. The first factor they need to manage is to manage the volume. Volume is what? Volumes of assets and liability, ensuring that they have the right amount. Second thing the bank need to manage is the mix of the balancing different kinds of investments and liability. They have also to make sure that assets and liability align over the time. Then comes rate sensitivity, which means handling fluctuation in interest rate, quality, liquidity and quality, which means ensuring that bank have enough cash and that their investment are safe and profitable. In short, we can say ALM ensure that bank don't run out of money while also making a smart investment. Now let's see what are the steps involved in it. Here you can see what are the steps involved to achieve this balance. So I hope it is clear why balance is so much important. To achieve this balance, bank follow a structured process. First of all, interest rate versus pricing, which means deciding how much to charge for loan and how much to pay on deposit. Second thing is called portfolio risk, which means managing currency fluctuation, which is called FX risk, and also ensuring that enough cash is there, which is called liquidity risk. The third thing is called the credit risk, which means keeping an eye on the loan repayment and dealing with interest rate change. Then comes performance review, which means checking actual profit versus expected profit and adjusting a strategy accordingly. Every decision impact the bank overall stability as well as the profitability. Now, so question is, what is the final goal? What is the target outcome? Let's look at it. The target outcome here. So the bank aim to achieve a predetermined acceptable risk to reward ratio. Yes, this is a predetermined risk reward ratio that the bank aim to achieve. And also that they want to maintain high quality asset while minimizing the risk. And also most importantly, bank ensure that financial health by balancing assets and liability effectively. In simple word, we can say ALM, the asset liability management, it's like heartbeat of a bank, keeping the financial system steady, healthy and risk free. It is what ensure your money is safe and bank stay profitable. So stay tuned as we explore some more key banking concepts. Now friends, let's switch our attention to the next slide that we have. Let's look at the structure. So in this slide, ever wondered how bank manage billions of rupees every day? Well, just like we have loan, we have liabilities, we have expenses, bank also have their own financial obligations, and these are called bank liability, right? So the money a bank or two other. But what exactly make up this liability? Let's break it down in the simple term. And friends, let's get started. Think of a bank liability as all the different sources from which it collect money, be it from customer, investor or even other banks. So these funds are not owned by the bank. Instead, they are obligation that the bank has to repay at some point. Let's look at the key component. If you really think that it adds value to your understanding, please hit that like button. This will motivate me to make more such content. Now friends, let's look at the deposits part. Here you can see the deposit. So basically, the largest chunk of the bank liability comes from the deposit. Means the money we as customer put into our bank account. It can be demand deposit. Like these are the funds that customer can withdraw anytime, like saving or current account. It can be term deposit, like fixed deposit that customer lock in for a specific time. Then we have saving bank deposit, a mix of both offering interest while allowing limited withdrawal. For bank, deposit are both an opportunity and a responsibility. They use this money to give out loan while ensuring depositor can withdraw fund whenever they need. Then we have the second part that is called borrowing. Let me take you forward to the borrowing. So basically, yes, even bank borrow money. Yes, even bank borrow money when they need extra fund. They take loan from RBI, right, or commercial bank or financial institutions, right. So this borrowing help bank maintain a smooth operation and meet customer demand efficiently. Then comes capital. Capital is also a part of liability. You look at it, capital. So bank is not just about customer deposit, right? It also needs capital to stay strong. So these include owner's stake, which means the money invested by the bank founder and the shareholder. Then financial cushion, which means capital reserves that help the bank, that means extra fund that keep aside for emergency. Then long-term fund. Long-term fund are like reserves. So these are like capital reserves that help the bank grow and expand. In simple term, capital act like a safety net, right, ensuring that bank remain financially stable in tough time. Then we have reserves and surplus, which we call extra protection. Here you can see reserves and surplus. So bank also set aside money as reserves and surplus, which include a statutory reserve. What is the meaning of a statutory reserve? It means, a portion of profit kept aside as per legal requirement. Capital reserve means, and share premium. What is the meaning of these two terms? So basically these are the money raised from shareholders. And then we have revenue and other reserves. So any leftover earning that help manage future risk. So these reserves act like a financial shield, protecting the bank from unexpected loss. Then we have other liabilities and provision. Lastly, bank have some additional liability that might seem small but plays a crucial role, like bills payable. So bills payable means that money owed for pending transaction, inter-office adjustment, that internal financial settlement between bank branches, interest accrued, which means unpaid interest that need to be accounted for. Other provision means funds set aside to cover risks like bad loan or default. This ensures a smooth operation. So in a nutshell, we can say bank liability represent everything that a bank owes to depositor, to other bank, and to financial institutions. Managing this liability effectively is what keep a bank profitable, right, stable and trustworthy. Now friends, the next time you deposit your money in your bank, just remember it is not sitting there. It is a crucial part of their financial system in action. Now friends, just like individual own house, car and investment, bank also have their own asset, valuable thing that can help them generate income. But what exactly do bank own? So let's explore the different kinds of asset that they have. So bank asset means everything that the bank own or has the right to receive. So first of all, the first kind of asset we have is called, as you can see, cash and balance with RBI. So basically it includes cash in hand. What is the meaning of cash in hand? Cash in hand means physical cash stored at the bank branch. Then balance with the RBI. Every bank maintain a reserve with the Reserve Bank of India. Then we have money at call and short notice, which means cash parked with other bank for quick access. So this cash ensure bank can meet withdrawal request and operate smoothly. Then we have investment part. What is the investment? Investment, bank don't just hold on to money, they invest it to earn profit. And it includes government security, means that these are safe investment in bonds which are issued by government, approved security, other regulated investment that bank are allowed to hold, share, debenture and bonds, right? And these are the company share, debenture and bonds, and then subsidiary and joint venture. So ownership is stake in other business. So by investing wisely, bank ensure they earn stable return. Then they have advances also. This is also an asset. So lending is the bank primary source of income. So they provide cash, credit and overdraft and loans. They provide term loan, bill purchase, yes, buying trade bill is at discount and earning profit later. This is also part of their income. Then we have the fixed asset, as you can see at the bottom. Fixed asset includes premises, furniture, hardware. I hope this is self-explanatory, no need to explain. Some other assets are there, like inter-office adjustment are there, right? This is another kind of asset. So basically financial transaction between different branch, interest accrued means interest earned but not yet received, tax paid in advance, TDS, prepaid tax that bank will adjust later, stationery and stamp, and non-banking transaction. In short, bank asset are what it own and earn from, ranging from cash in hand and investment to loan and property. I hope that makes sense to you. Now friends, let's look at bank income component. Now let's shift our focus to the profit and loss account. So bank income component. Have you ever wondered how do bank earn money? After all, they give us loan, pay interest on deposit and provide various service. But behind the scene, bank have multiple sources of income that keep them running profitably. The first income they have is called the interest income, and the other side we have is called other income. So let's first see the interest income part, right? So first of all, it comes interest or discount on advance or bill, right? So basically when bank give loan or when bank buy bills, they charge interest, which is their primary revenue stream. Then income on investment. Just now I told you that bank don't just lend money, they also invest in securities. Then interest on balance with RBI and interbank fund, which means that just like we earn interest on saving, bank earn interest on their deposit with the RBI and the other bank. Then some other interest related activity like different financial statement. Simply put, bank borrow at low rate and lend at higher rate. This gap is how they make the money. Then comes other income. Other income includes commission. You can see commission, exchange and brokerage, right? Which means that fee earned from foreign exchange transaction, trading and banking services. Profit on sales of investment. If the bank sells share, bonds or any asset at higher price, they make a profit. Profit on revaluation of investment, which means when market price rise, bank can book profit on that investment. Profit on sale of land, building and other asset. Bank just like real estate, bank on property can also be sold at profit. Profit on exchange transaction, it very well. What is the meaning of exchange transaction? Just like real estate, bank on property can also bank charge fee on foreign currency transaction. Dividend income is also there. Charges, bank also invest in company and earn dividend. And there are some miscellaneous income like ATM withdrawal, penalties, service fee. In short, bank don't just make money from loan, they have a variety of income stream. So the next time you enter a bank, remember, it's not just a place to save money or take loan. It is a powerful financial institution earning from multiple sources. Now look at the bank expense. So friends, let's look at bank don't just give loan, they also borrow money from depositor, other bank and RBI. So bank pay interest too. So there is something called interest on depositor. You know it very well. Interest on RBI interbank borrowing and other. So these are the different kinds of interest expenses of the bank. But besides that, before bank can make money from loan, they first need to pay for money they borrow, right? Like payment to employee, right? So salaries, bonuses, benefit for bank staff, then rent, tax and lighting, right? Printing and stationery, advertisement and publicity. I hope this does not require any explanation. Yes, this point is depreciation on the bank property, which means just like a car lose value over the time, bank property and asset also depreciate. Then the directors and auditor fee, law charges, repair and maintenance, insurance charge, other expense. So basically, in short, bank spend a lot to operate efficiently and provide seamless service to the customer, right? So friends, this is the part. Now we are offering 35% discount on our crash course. Yeah, you will be highly delighted to know it. We are offering this 35% discount on our crash course, so we can take help of this particular offer, right? You can install our app. In the description section also you will check, you can check the this particular offer, right? And you can enroll in our crash course program. This will, if you are looking for any such course which provide you everything that you need for last time revision for last 1 to 2 months, then you are at the right place, because our crash course offers the same. It provide you at least cover at least 50 to 60% of the syllabus, right? That will help you score at least 50 marks in the examination. So friends, now let's look at how do we know if the bank is performing well. Just like we check our financial health using saving, income, expense, so bank use some key financial ratios to measure their stability, profitability and risk. So let's look at some ratios. The first is called net interest income. This is the bank earning engine. Every bank earn interest from loan and investment, but also they pay interest on deposit and borrowing. So the difference between these is called NII. This is called net interest income, right? So what bank is earning from loan and what they are paying interest to the deposit. So that is called NII. You can see interest income minus interest expense is called NII. So see, if NII is higher, it simply means a stable earning, right? And if NII is lower, it simply means that more risky and unstable. So bank aim to reduce NII fluctuation so that their short-term profit remain steady and predictable. So the main aim of the bank is to reduce the NII fluctuation. Anyway, they don't want NII to fluctuate. If it is fluctuating, they want to reduce it. Then the second parameter we have is called NIM, net interest margin. It tells us how efficiently a bank earn from its asset. How efficiently bank earn from its asset. It is calculated as NII divided by earning asset, right? Total asset, or we call it total asset. So if NIM is higher, it means more profitability, and if NIM is lower, it means, but NIM, higher NIM can also mean higher risk. Yes, profitability is okay, but risk is also high. So to succeed, bank must balance profitability with smart risk management. Then comes economic equity ratio. Remember one thing, NIM is higher, it means yes, the bank is profitable. That means it is earning well on its asset, but on the same time, it is risky also. And if you look at the economic equity ratio, this ratio shows how much of a bank total fund come from shareholder own money, that is called capital, instead of borrowing. So to derive the formula, we write the shareholder fund in the numerator, right? Shareholder fund in the numerator we write, and in the denominator we write the total asset. Means how much of the bank total fund, which is the total asset, comes from the shareholder own money, that is called capital, right? So a strong capital ratio, which we also call it capital ratio. Instead of economic equity ratio, we also call it capital ratio. If so, it simply means a strong capital ratio means bank can handle financial shock better, because more investment is coming from shareholder fund. But if a bank with low capital ratio are more vulnerable to the financial crisis. Simply put, this ratio tells us how financially stable a bank is. So to evaluate a bank performance, we look at NII, which means how much a bank earn after paying interest. We look at NIM, which means how efficiently a bank profit from its asset, and we look at EEQ, EER, economic equity ratio or capital ratio, how strong and self-reliant a bank is, right? That is the bank performance metrics. Remember these three ratios, super important. Case studies based on this is asked. Now, asset liability management objective, very very important. One question was asked in the summary examination from this particular slide. Ever wondered how bank maintain financial stability? It is all about balancing assets and liability efficiently, and this process is called asset liability management. This is the secret behind a strong and profitable bank. First of all, what is ALM? ALM, you can think of bank as a giant financial seesaw. On one side it has asset like loan and investment, and on the other side it has liability. So the goal is to keep the balance right. So ALM help bank to manage financial risk, to ensure long-term stability and to maximize profitability. These are the main aim, right? ALM, that is what ALM help. So let's look at the macro level objective, right? What is the macro level objective of ALM? Here you can see the first is, policy formulation. At higher level, bank focus on policy formulation, which means setting clear financial strategy, capital allocation, which means smartly distributing the fund, product design, which means that creating profitable banking product, and pricing strategy, which means deciding the right interest rate for loan and deposit at the macro level, right? And what is the micro level objective? Means zooming in. If we zoom into, right, bank have two main objectives. The first is profitability, which means matching income and cost effectively. Then liquidity, which means ensuring that they always have enough cash to meet their obligation. This is the micro level objective, profitability and liquidity. So then comes price matching. What is the meaning of this price matching? You see this word written here, price matching. So at the micro level we are talking about. Let me zoom a little bit, right? So this is price matching. What is the meaning of price matching? Bank earn money by charging higher interest on loan than they pay on deposit. That is their earning. So the spread, this is also called a spread, means interest income minus interest expense is also called the spread. Their spread is the key. But if interest rate rise, suppose, try to understand, if interest rate increase, right, so a positive gap in such case, what is the meaning of positive gap? Asset is greater than liability is called positive gap. If interest rate right, a positive gap, it means more profit. And suppose if rate drop, if interest rate decrease, right, and there is a negative gap, means liability is greater than asset, it means it lead to losses, right? That is the point. No, it lead to gain, right? If the rate drop, try to understand, if the rate is dropping and there is a negative gap, then it also causes a gain. The smart bank balance this risk to keep their earning steady. That is called price matching, right? And the second part is called liquidity management. I think I told you now, profitability is ensured by price match. Why you can see whether rate is increasing or not and whether the gap is positive or not, right? This decide the price matching. And second is called liquidity management. So just like we need saving for emergency, bank need liquidity to meet customer withdrawal and payment. And how do they do it? They do it by analyzing their maturity profile, when assets and liability are due. They do it by doing the gap analysis, which means checking if future fund meet the future need, and by managing the mismatch, which means avoiding liquidity crisis. Three way I told you. Maturity profile they analyze, right? We will talk in detail about it. Gap analysis they analyze, right? And managing the mismatches. So this way they ensure liquidity management. So to conclude, asset liability management is the financial backbone of a bank. It ensures that bank stay stable and profitable, interest rate work in its favor, enough liquidity is available to meet obligation, right? Profitability and liquidity, two key pillars of ALM. First pick we have, everything will be in the pictorial format so that you can easily understand it and visualize it. This will help you in the final revision. So friends, this is a crucial part of banking regulation and we are talking about Basel framework pillars, right? So friends, what is the meaning of it? See, first thing is that pillar number 2, which is based on supervisory review process. In short, we call it SRP. So this SRP, it ensures that bank hold enough capital, right? So what does this SRP ensure? That means this SRP ensures that bank have enough capital to cover all the risk, right? So here the key point, to cover all the risk, bank should have enough capital. That is what SRP ensure, not just one under the pillar 1, right? So what I'm telling you, that it ensures that bank have adequate capital to cover the all possible risk, right? So all risk, this is the key point. Let me highlight it. Let me highlight this point, all risk, not that just cover under pillar 1. So the goal is that a stronger risk management. This is the goal, a strong risk management and financial capability, stability. Now let's look at some key aspect under this SRP and ICAAP. So basically some risks are partially covered in pillar 1. What are the risks which are partially covered in pillar 1? Like credit risk, market risk and operational risk. But other risks are completely outside pillar 1. This question is asked, which risks are not covered in pillar 1? Like liquidity risk is not covered, interest rate risk is not covered in pillar 1, strategic risk is not covered under pillar 1, right? There are 3 pillar to the Basel 3. So pillar 1 we are talking about, reputational risk is not covered under pillar 1, right? So these kind of risks are completely outside pillar 1. And there are some external factors like economy, right? Economic trends, then regulations, then even political influence. So these things are some external factor. Then comes pillar number 3. Let's look at pillar number 3. So pillar number 3 is, it's called market discipline. You can think of them as a transparency pillar. In simple word, if you want to define this market discipline, you can talk of them like, transparency pillar, right? So it works alongside pillar 1 and 2. It complements pillar 1 and 2, right? To promote openness in the financial disclosure. What is the focus here? to make critical financial data public, right? To make the data public, this is the focus, to make the critical financial data public, so that the market player from investor to the regulator, so that the market player from investor to the regulator can make informed financial decision. There are some key disclosure areas here, like, so bank must reveal some detail about, you know, capital adequacy and risk exposure and risk assessment process to ensure trust and stability. So in the world of banking, just like in a game of darts, hitting the target is not just about one perfect throw. It's about precision, strategy, and managing every risk along the way, right? So I hope this makes sense to you. What are the risks which are covered under pillar 1? What are the risks which are not covered under pillar 1, right? What are some external factors which influence our risk, SRP and ICAAP, right? What is SRP? What is the objective of SRP? What is market discipline? What is the focus of market discipline? What are the key disclosure area? This we have discussed in this particular slide. Now let's look at this slide. In this slide, you will be able to understand each and every point regarding the SRP, which we call supervisory review process. Risk is everywhere in banking, but how do banks ensure that they have enough capital to survive uncertainty? So the key question is, how do banks ensure that they have enough capital to survive the uncertainty? So the answer is SRP, supervisory review process. It is a crucial pillar of the Basel framework that keep the financial system strong and stable. So let's break it down. The first point here is, you know, CAR, regulatory CAR, or we call it capital adequacy ratio. You see the first point here, regulatory capital adequacy ratio, right? Regulatory CAR. So it is defined under pillar 1. Remember, this regulatory CAR is defined under pillar 1, right, as the minimum capital requirement. It is a minimum capital which is requirement, right, which is set by the RBI. Who set it? It is set by RBI. So basically, if we talk about the regulatory CAR, this is defined under the pillar 1, right, as minimum requirement set by the RBI. It covers which kind of risk? Credit risk, market risk, and operational risk. I told you already that pillar 1 covered only this kind of risk, right? CAR, minimum capital requirement set by the RBI. Now the problem is that it may underestimate the actual risk exposure that the bank face. Yes, some actual risk exposure that the bank face is underestimated by the CAR. Now, what are the risks which are not fully captured in regulatory CAR? You can see interest rate risk. Like, you know, change in rate can impact a bank profitability. Second is a credit concentration risk. Like, you know it very well. Credit risk, we can call it. Liquidity risk is not covered under it. That the ability to meet obligation on time. Settlement risk, you know, ensuring a smooth financial transaction. Then we have reputational risk, like the bank trustworthiness always matter. A strategic risk and climate risk. So, you know, this kind of risk are long term, it ensures long term sustainability and external impact. So let me write down long term sustainability and external impact. So what was the need for the additional capital? So these are the risks which are not captured under regulatory CAR. Now the question is need for additional capital. What is the need for additional capital? So some risks get underestimated under pillar 1. Yes, some risks gets underestimated under pillar 1. Each bank face unique risk exposure, right? So depending on its risk management quality, each bank face unique risk exposure. This is why just meeting regulatory requirement is not enough, right? Each bank faces unique risk exposure. So that is why meeting just regulatory requirement is not enough. So this is the point. Then ICAAP comes into picture. You must know the full form, internal capital adequacy assessment process, right? So why additional capital was required? I told you, because some risks get underestimated under pillar 1, some risks are not captured, right? And so meeting regulatory requirement is not enough. So bank must assess their own risk exposure beyond just the regulatory minimum. Yes, so bank must independently assess their risk exposure. This is what is ensured by ICAAP. Second thing, bank need to maintain extra capital cushion for some unaccounted risk. Just now we have told about some unaccounted risk. And you know, there is no single universal approach for ICAAP that exists. Every branch must design its own approach. Remember it. That is why this word internal is used here. Why internal word is used? Because this process vary from bank to bank. Every bank, there is no single universal approach for ICAAP. Every bank has designed their own unique ICAAP. In short, we can say that regulatory capital rules are just the starting point. The supervisory review process. So these all things are under supervisory review process. So this supervisory review process ensure that bank go beyond the minimum and prepare for all possible risk to safeguard the financial stability. Like this kind of risks are not taken into consideration by the CAR, right? So Basel 1, under pillar 1 only we are talking about capital adequacy ratio. Under credit risk, market is operational risk. But what about this kind of risks? These are not taken care of the CAR. But how to account for them? In order to account for them, bank must prepare their own internal capital adequacy. Means depending on this risk, while capitalizing this kind of risk, banks should have their own internal capital adequacy assessment process. Right, that is the point. So friend, this kind of understanding we try to make you clear using this crash course. Only thing that matter, if you go through book, there's a lengthier line, right? You can't identify what to skip, what to read, and what I am providing you in the crash course is just hit the bullseye. You know what meaning of hit the bullseye? It means you just focus on what matters, nothing else. And if you want to get such kind of videos for each and every subjects, you can WhatsApp me on this particular number, because on YouTube, right, all videos are not available, right? For more detail you can WhatsApp me, right? There is a 35% discount going on this particular crash course. You can take use of that. There are individual crash course also. Let's continue our discussion further. So now that we know the importance of supervisory review process, right, it ensures that bank go beyond the minimum and prepare for all possible risk to safeguard the financial stability. Now let's look at pillar number 2. Friends, this is super important. In the world of banking, just meeting minimum capital requirement is not enough. Bank must go beyond the basics to ensure the financial stability, right? So that is where pillar 2 of the Basel framework comes into play. Let's shift our focus to the pillar 2. And pillar 2 is what? Strong supervisory process. So pillar 1 was what? Minimum capital ratio or capital adequacy ratio. Pillar 2 is what? Strong supervisory review process. You know it, SRP. And pillar 3 is regarding the disclosure. So there is a separate chapter on disclosure, but now we are focusing on pillar 2, that is supervisory review process. So let's break down the 4 key principles that keep our banking system resilient. So the first principle is the bank responsibility. There are 4 key principles under supervisory review process. Let's go through each and every one of them. I hope it is visible. If it is not visible, let me zoom a little bit, so that now I hope it is visible to you. What does pillar 1 say? That bank are not just passive player. Remember, bank are not just passive player. They are not just passive player, right? They must assess their own capital adequacy based on their unique risk profile, right? Based on their risk profile, they must assess their capital adequacy. This means developing solid strategy to maintain sufficient capital level at all the time. That is the bank responsibility, that they must assess their own capital adequacy. Every bank has a different capital adequacy based on their unique risk profile. So a strategy must be developed by them, right? Solid strategy must be developed by them to maintain sufficient capital level at all the time. That is principle number 1. What is principle number 2 says? Principle number 2 is about supervisory review. That means it is that supervisor, or maybe we can say regulators. Either you call it supervisor or you call it regulator. So it says that sorry friends, that regulators steps in to review and evaluate the bank internal capital assessment. It is the role of regulator to step in and evaluate the bank internal capital assessment. They ensure that bank follow regulatory capital norms, right? And if bank falls short, supervisor take corrective action to prevent risk from escalating. That is called supervisor review. That is our principle number 2. Principle number 1 is about responsibility of the bank, that they should have internal capital adequacy assessment process. And principle number 3, just look at it in this side. Principle number 3 is capital above minimum requirement. So banks should maintain capital level above the regulatory minimum, because minimum is not always enough. Supervisor can demand additional buffer if they spot high risk exposure. Yes. So suppose supervisor spots some high risk exposure, so they can require additional capital buffer. That is principle number 3. And what is the principle number 4? Principle number 4 is on the left side. Let me show you. Yes, this is the principle number 4. It says that prevention is better than cure, right? So supervisor act early to stop bank from falling below the required capital level. So there is something called required capital level, and if the bank fall below the required capital level, then supervisor must steps in. If the capital dips too low, swift corrective measure must be taken to restore the financial health. So the bottom line is that bank can't just rely on regulatory number. They need to think ahead, assess their risk, maintain a solid capital base, right? And with active supervision and intervention, the system stays strong even in uncertain time. So that is the important point which we have just discussed now. I hope that makes sense to you. Now friends, let's move forward. Let's see the next part. Next slide that we have is regarding the ICAAP. So one slide on the SRP we have just seen. What is the role of SRP, supervisory review process. Now one slide on ICAAP. So what is ICAAP? Ensuring financial stability in the banking sector is not just about meeting the minimum capital requirement. I told you earlier, several times I told you that if you want to ensure financial stability in the banking system, it's not just that you have met the minimum capital requirement, that is enough. No, it's about proactively managing risk. So the key word here is, let me highlight, is proactively. Sorry. Proactively managing risk, right? And staying prepared for uncertainty. What is ICAAP? ICAAP, you know, it is a central mechanism that help bank assess and maintain sufficient capital based on their risk exposure. So this help bank assess and maintain the sufficient capital based on their risk exposure. This is the central process. I hope that makes sense to you. If you look at the objective of ICAAP, as you can see, so ICAAP is not just a compliance checkbox. It's a strategic approach to risk management. It focuses on, first of all, risk identification and measures, which means identifying and quantifying all possible risks that bank might face. Then capital adequacy, which means, you know, aligning capital reserve with the risk level to ensure a strong financial cushion. So two things are there. On one side you have, you know, capital reserve, how much capital reserve we have, and the other side we have the risk level, and you align both of them. Why you align both of them? To ensure a strong financial cushion. And the third thing is risk management development, which means continuously improving risk management framework to handle the evolving challenges. That is the improving framework. So these are the three objectives of ICAAP. First one, risk identification and measurement. Second one, capital adequacy. Third one, risk management development. Now what is SRP? SRP full form is, you know, supervisory review process. So what does it mean? So ICAAP does not work in isolation. Regulator steps in to review and validate a bank ICAAP framework through. What are the steps that regulator used to review and validate a bank ICAAP? The first is ICAAP review. What is the meaning of this ICAAP review? You know the meaning of ICAAP review. Let me explain. It says that assessing the bank internal risk framework. Second is risk assessment, conducting an independent valuation of the risk exposure. The third thing is supervisory action, taking corrective measure if capital buffer are insufficient. If we talk about the structural aspect, so for ICAAP to be truly effective, you know, it must be integrated into the bank risk management system. How to integrate it into bank risk management system? So the first way is should have a clear policy. That policy should be clear, which means, you know, well-defined guideline, procedure and risk limit. Second thing is risk monitoring, which means, you know, continuously identifying, mitigating and reporting the risk. Robust MIS, robust management information system. So a well-structured MIS for real-time tracking. And finally we have a strong internal control, which means effective mechanism to prevent, right? So there should be, you know, effective mechanism to prevent and what? To prevent and detect financial risk before they escalate. So basically these are the structural aspects. For ICAAP to be truly effective, it must be integrated into the bank risk management system through clear policy, risk monitoring, management information system and a strong internal control. So why does it matter? Because bank operate in an environment full of uncertainty, economic downturn, credit risk, operational risk. So ICAAP ensure that they stay ahead of the game by proactively managing risk. In short, a well implemented ICAAP framework is not just about compliance, rather, you know, it's about building a resilient future ready banking system. Now friends, let's look at this particular slide. And as you can see, the topic is board of director responsibility. Very, very important, right? So basically in the world of banking, maintaining capital adequacy is not just the responsibility of risk manager. It is start at the top. So the board of director plays a crucial role in ensuring that ICAAP is implemented effectively. So the board ensured that, the first point you will see, a strategic planning for capital management. The board ensured that bank is financially sound by carefully planning the capital need. First thing is current capital need, which means assessing the bank existing capital position. Second thing is future capital need, which means anticipating long-term financial requirement. Third thing is anticipated capital expenditure, which means planning for investment and expansion. So anticipated capital expenditure means, well, you know, you are planning for investment and you are planning for, you know, expansion. That is called a strategic planning for capital placement. And the fourth thing is desired capital level, which means ensuring adequate capital buffer for risk resilience. The next point we have is strengthening the internal control. What does it mean? So robust internal control are the backbone of risk management. Internal control is very, very important. So the board must implement a stronger internal control. That means prevent fraud, prevent the operational risk, establish some written policy, which set clear guideline for compliance and governance. Right. So strategic planning is needed. What is the current capital need? You should anticipate the future capital need. You should anticipate the capital for investment and expansion. Then we have risk tolerance and framework. which means that exit acceptable risk level to avoid instability, that this much risk should be maximum risk that should be tolerate, that is called risk tolerance. Ensure senior management, that guide leadership in risk decision, and establish risk management framework, which means a structured approach to identify, assess and mitigate the risk. And finally we have risk monitoring and compliance. This is also done by a board of director. So effective risk management is not just about policy, it's about constant vigilance. Yes, constant vigilance is very necessary. That once policy are set, the board ensure that continuous risk monitoring is there, tracking risk in real time to avoid surprise, and regulatory compliance. Why does it matter? Because a strong board leads to a strong bank. Their strategic vision, their oversight ensure that ICAIIB is not just a framework but a real working strategy to keep the bank resilient, profitable and secure in the long run. So that is a board of director responsibility, right? I hope that makes sense to you. Now let's look at ICAIIB document structure. What kind of documents are included in it? So understanding ICAIIB, that is internal capital adequacy assessment process, is essential for ensuring financial stability in bank. But how do we document and structure the ICAIIB process? Let's look at it. Let's explore the ICAIIB document structure and its key component. First of all, every document starts with a strong foundation, that is called the background. So as you can see, there is a background here. So it starts with every document starts with a strong foundation. So the ICAIIB start with context and scope. You can see context and scope. What does it mean? That defining the purpose and framework. There is something called executive summary. Executive summary what includes? Like a quick snapshot of ICAIIB is provided here. It covers the purpose of ICAIIB report, means why is it important, and regulated entities covered, means which banking unit fall under ICAIIB compliance. So this is the executive summary. Then we have key sensitive and future scenario, which includes risk is not static, it evolves. Risk always evolves. It is never static. Risk always evolves. So this section help bank prepare for uncertainties. How the bank prepare for uncertainties? By the identification of material risk, means what could go wrong. By projecting the risk, future risk, means estimating possible financial impact. And the next point we have is the capital adequacy. You can see it here written here. Let me show you the capital adequacy part. Yeah, here you can see capital adequacy, which means to stay financially sound, bank must maintain the right capital level. So this is included in ICAIIB document. That means minimum CRAR requirement. Then there is a column of summary of financial and capital position, means a clear picture of the bank financial health is outlined here, means what is the current financial standing, where do we stand today, and what is the projected financial standing, what is the outlook for the future. Then there is risk oversight and management, which means effective risk management keep the bank secure, and this section include a specific risk category, means identifying the different kinds of risk that we have, and the mitigation strategy, means how to control and minimize the risk, and use of ICAIIB in bank. So basically ICAIIB is not just a document, it is a decision making tool, right? It is a decision making tool, very important thing. Why? Because bank use it for decision making integration, means using ICAIIB insight in strategic planning. Yes, bank use ICAIIB insight in strategic planning. This is very important thing. And the second way the bank use ICAIIB is risk governance, which means strengthening the risk management framework. Then there is something called aggregation and diversification. So risk should not be concentrated, right? Diversification ensures resilience and impact on capital planning. What it means? That adjusting capital strategy based on risk aggregation. So a plan without testing is just a theory. So ICAIIB must be validated. You can see testing and adoption of ICAIIB. So a plan without testing is just a theory. So ICAIIB must be validated with proper methodology, which means ensure reliability of capital assessment, and it should be approved through a structured process, which means gaining regulatory and internal approval. So a well structured ICAIIB document help bank navigate financial challenge, regulatory compliance and risk uncertainty with confidence. Now friends, let's look at the guiding principle and requirement for the bank pillar 3 disclosure. Let's look at this particular slide. So friends, transparency is the backbone of a strong and stable banking system. But how do banks ensure that their financial disclosure are clear, meaningful and consistent? That is where pillar 3 disclosure comes into play. Let's break it down. First of all, the guiding principle. There are 5 guiding principle for pillar 3. The first is clarity, which means information should be easily understandable for the stakeholder. Second is comprehensiveness, which covering all essential risk area without any missing detail. So this is pillar 3 disclosure, right? Comprehensiveness means covering all essential data without missing detail. The third principle is meaningfulness, which means the data must be relevant and insightful for decision making. That it must be relevant and it must be insightful for decision making. Our principle number 4 is consistency over time principle, which means disclosure should be uniform, it should be consistent, it should be uniform, right? Why? To allow easy comparison across period, and it should be comparable, which means investors should be able to compare different bank risk exposure effectively. That investors should be able to compare different bank risk exposure. So it means different bank exposure should be compared easily. So these principles ensure that financial disclosure are not just a formality, rather a powerful tool for transparency and trust. If you look at the scope and frequency of this pillar 3 disclosure, here you can see on the right side. So basically, how often and at what level do bank need to disclose the risk information? Do you know how often and at what level? So basically, let's understand the rule. The scope is to top consolidated level, which means the main banking group provide the disclosure, which is the top consolidated level. Second is the parent bank disclosure. No need to include all subsidiary detail except significant subsidiary disclosure. This must be disclosed separately. So this is the scope and frequency, right? And frequency of disclosure, very important. Question are asked most frequently from it. So that at least half yearly frequency at least. That means that bank must update a stakeholder at least twice a year, and quarterly disclosure for key financial aspect like capital adequacy and credit risk, they require more frequent update as quarterly. So this is asked that in general it is half yearly, and for some specific it require quarterly update. I hope that makes sense to you. Now let's look at this banking securitization disclosure. So the mode of disclosure, where one more thing I think I left it, yes, where we can disclose it. It is published in financial statement. So publish report containing risk and capital data, and direct website link is also there. So this ensures that financial data is readily available. So pillar 3 disclosure, it act like a critical link between bank and the public, ensuring openness, accountability and trust in the financial market. While disclosure should be clear, comprehensive, meaningful, consistency, comparable, they help investor and regulator make informed decision. Now friends, let's look at this particular slide, and this is super important. So securitization is a game changer in the modern banking, allowing financial institution to transform illiquid asset into tradable. I think you know about securitization, right? What bank do? That they can transform some illiquid asset, their asset which are illiquid. So using securitization, they can transform this illiquid asset into tradable security. So that is the role of securitization. So they can transfer illiquid asset into tradable security. But to ensure transparency and risk control, right, bank must make detailed quantitative disclosure. So let's explore what this disclosure should cover, right? So securitization means converting the illiquid asset into tradable security. But to ensure transparency and risk control, there should be quantitative disclosure. It should be done. So what this disclosure cover? First of all, banking book. So whenever I say banking book, it means what? We are managing exposures and capital. So when banks securitize their asset, they need to disclose key figure related to their banking book, like how much exposure is securitized, means the sum of all the asset converted into security, losses on securitized exposure, which means any financial hit from this transaction, asset plan for securitization, means that is called future securitization strategy, newly originated asset for securitization, which means fresh asset add to the pool. Then we have total securitized exposure and unrecognized gain or loss, which means the total value of securitized asset and any unrealized profit and loss. Then we have securitization of exposure on and off balance sheets, which means tracking both direct and indirect exposure. Capital charge on retained or purchased exposure, means capital requirement bank needs to hold when retaining or buying back securitized. And finally, capital deduction detail, which means a specific deduction applied to calculate regulatory capital. So all these disclosure help regulator and investor assess the bank risk exposure and its ability to absorb the loss. Finally, on the trading book side, you see when bank deal with the securitized asset as part of their trading activity, they must disclose that how much is exposed securitized, right? The total securitized asset in the trading book, securitization exposure, which means just like in the banking book, tracking all trading related exposure, a specific risk capital treatment, how much capital the bank set aside for risk tied to a specific security, and securitization framework for a specific risk. That means the bank methodology for risk tied for handling risk from securitized position. So these disclosures ensure that trading book remain well regulated, transparent and adequately. So the question is, why does disclosure matter? Because securitization when managed well enhance liquidity, reduce risk and improve capital efficiency. But if risks are not properly disclosed, it can lead to major financial instability. So clear, detailed disclosure help regulator, investor and the public understand the bank risk exposure, ensuring a safer and more criteria. In this particular slide you will be able to see all the kinds of criteria for the NPA classification. So let's get started with our first topic, that the first thing is long duration crop, right? So let's break down the NPA classification criteria. First of all, we have long duration crop. As you know very well, for long duration crop means crop that take more than one crop season, right? So some crop they take so basically long duration crop. So if the principal or interest is overdue for more than 90 days, it become NPA. Try to understand, either principal or interest, right? If the principal or interest is overdue for more than 90 days, actually it is not 90 days, rather it is one crop season. It is not talking about 90 days, there is nothing, no concept 90 days. So remember, for long duration crop, if principal or interest is overdue for one crop season, right, then it is called NPA. This is the first point. Second point is short duration crop. What about the short duration crop? For short duration crop, as you can see here, let me just take you. So as you can see, a short duration crop, installment of principal or interest overdue for two crop season. So remember this thing, for long duration crop it is just one crop season, for short duration crop it is two crop season. Then if we talk about the term loan, so remember, for term loan, if the principal or interest is overdue for more than 90 days, so here the 90 days concept is there. What is the meaning of overdue? So overdue, if the principal or interest is overdue for more than 90 days, then the term loan become NPA. And then we have OD and CC account. What is the meaning of OD and CC account? You know it very well, that if overdraft balance exceed the sanction limit, this is called out of order. So remember, the key word here is out of order. What is the meaning of out of order? That means outstanding balance exceed the sanction limit or drawing power continuously, right, for 90 days. And so first there are two conditions there. Either outstanding balance exceed the sanction limit or drawing power, or no credit is there for last 90 days. So it can so under both these conditions, the OD or CC account will be classified as NPA. Then we have bill purchase or bill discounted. So let me show you where it is written. I think yes, bill purchase and bill discounted. So remember, if the bill remain overdue and unpaid for more than 90 days, right? So suppose bill remain unpaid and overdue for more than 90 days, right? In that case, we will say that or suppose it is a discounted loan, then also it become a part of NPA. Then we have something called securitization transaction. So liquidity facility that remain outstanding for more than 90 days can also be considered NPA in the case of securitized transaction. I hope you are familiar with this securitization. We have discussed in detail about it, right, in our courses. Now friends, then we have something called derivative transaction. So what is the derivative transaction? See, if the receivable from the derivative, right, if the receivable from the derivative transaction remain overdue or remain unpaid for more than 90 days from the due date, it will also be classified as NPA. So friends, these are the important NPA classification criteria that you need to remember. It is very crucial to understand this, especially obviously for your BFM examination. Friends, what I am trying to do in this crash course is to cover all the important points from where questions are asked. We are not going into detail. If you want detailed lecture, you can go to our detailed course, right, in which I explain why it is one crop season, what is the meaning of two crop season using example. But right now we are focusing on only those things that matter, so that you can revise the concept in the easiest manner. Now friends, let's switch our focus to the next important points we have, that is advances under consortium management. What is the meaning of consortium management? So friends, first of all, you have to determine the asset classification. So in consortium management, the classification of asset is determined by the individual member bank. It is determined by let me zoom a little bit. I hope it is not visible to you. Let me zoom a little bit so that the slide become very clear. Now I hope it is visible now. So friends, if we talk about the consortium management, what happened, that the classification of asset is determined by the individual member bank. Remember it is, right, and based on their recovery record, right. This means each bank assesses the health of the asset on its own term. This is the first point, very very important, because whatever I am telling you, question may be asked from there. Then the second point is pooling of remittance issue, which means when remittance are pooled, they are not shared, they are not serviced across the different bank involved, right. If the remittance are not serviced properly, they are classified as NPA, right? They are classified as NPA by the affected bank. So the pooling process is essential for accurate record keeping and proper asset classification. I have discussed in detail about this pooling process, right? I'm not going to, so suppose, let me give you one example. Suppose three banks are there, A, B and C. A is the lead bank, right? And this lead bank, and suppose this is the borrower. So borrower make payment to the lead bank, but suppose A did not pay to bank B or A did not pay to bank C. This is called, pooling. If pooling does not happen, then in the account of B, this borrower, in the account of bank B, the borrower will be NPA, and in the account of C, the borrower will be NPA, because A is not providing the money, A is not providing to the fund to B and C. That is what the meaning of pooling. Just in a simple way I have told you. Now friends, we have something called resolution for proper classification. It is important for all member bank to work together and resolve any issue related to asset classification, right? Any kind of issue has to be resolved which is related to the asset classification. So this collaborative effort ensures that assets are classified correctly and all recovery actions are in line with the regulation. Then we have something called security erosion threshold. What it means? So this is the point at which security backing the loan start to erode. There are some security which is backing the loan and security start eroding, right? Essentially, the value of security is evaluated, and if the security value drop, the classification of the asset changes accordingly. And let me tell you, if the security value is less than 50% of the assessed value, last assessed value, right? So here you can see, if the security value are less than 50% of the last asset value, then that particular account is classified as doubtful asset. Very, very important point. Please understand it. Super important. When an account will be classified as doubtful, if the security value is less than 50% of the last assessed or accepted value as by the bank or RBI, such account will be called doubtful. So remember, in this crash course, what we are doing, I am not leaving any point from where which is not important, because we are covering all the important points here, right? Now then we have classification as a loss asset. What is the meaning of loss asset? In some cases what happen when the value of security fall below 10% of the outstanding loan, right? So suppose outstanding loan is 1 lakh, and what is the 10%? 10,000. Suppose security value is 5,000 only. So in such case what happen? In such case the asset is directly classified as loss asset. Remember it. You have to directly classify the asset as loss asset, right? So in this case the existence of the security is disregarded and it's treated as complete loss. So it is the worst case scenario. So to summarize, when dealing with advances under consortium management, it is essential to monitor the health of the asset, ensure proper classification, and make sure that remittances are properly serviced. This will help you avoid falling into NPA category and ensure better financial health for the bank. I hope this helps you understand the consortium management in better way. Now friends, let's switch our focus to the next topic that we have. It is NPA classification for agriculture loan. So friends, let's dive into important aspect of banking. First of all, let's talk about the agriculture advance. The first thing to know is that agriculture advance are classified based on two key factors. The first factor is whether the loan is for short duration crop or long duration crop, right? So or whether the loan is government guaranteed or not. So we'll talk differently about both of them. So first of all, let's shift our focus to the short duration crop. So if it is a short duration crop, if it is yes it is a short duration crop, then you have to see that for loan which related to the short duration crop, if the loan payment is overdue for more than 2 crop season, remember, if it is overdue for more than 2 crop season, it will be classified as NPA, right? If it is overdue for 2 crop season, it will be classified as NPA. And if it is not a short duration crop, suppose it is a long duration crop. See, this is a flow chart which help you understand each and every point. Suppose it is not a short duration crop, rather it is a long duration crop. Then you have to see whether it is overdue for 1 crop season. If it is, then it will be NPA, right? Now let's switch our focus to the government guaranteed advance. In the right side you can see government guaranteed advance. Friends, now if the loan is government guaranteed advance, we have a further classification based on whether the government guarantees is from state government or central government. Yes, we can further classify whether it is from central government or state government. So if it is a central government guaranteed, if the loan is guaranteed by the central government, it is not classified as NPA. Remember, it is not classified as NPA until the guarantee is repudiated. So as long as the government stands by the loan, it is safe from NPA standard. Remember, I am talking about central government guaranteed bond. Now, suppose it is not central government guaranteed, suppose it is state government guaranteed, then what happens? However, if the loan is guaranteed by the state government and the payment is overdue for more than 90 days, right, then it will be classified as NPA.
So now you can see how agriculture loan are classified based on the types of crop and the government guarantee. Remember, if the loan remain overdue for more than 90 days, it will be classified as NPA, but there are some exceptions based on government guarantee. You see, for a state government guaranteed bond, if loan is guaranteed by state government and the payment is overdue for more than 90 days, it will be classified as NPA. So I hope this particular diagram help you understand the complete chart. See, after what I'm telling you, that if you want to get good marks in BFM, so you can take help of our crash course. How? You go through this particular video, this PDF will be available for you for revision. You can download them also in our crash course. So for your revision purpose. And basically what our main focus is, that our main focus is 80% of the time should be devoted to MCQ solving, and on daily basis I am updating MCQs and quizzes in the course. So your priority should be to attempt those MCQs and quizzes repeatedly, right? You should see whether after attempting quiz you are getting 60% marks or not, because if you clearly understand the fact which I am telling you in this particular video, 60% marks you will easily achieve, right? So let's continue our discussion further onward. Now friends, we have understood this thing. Now let's look at NPA classification and export financing, again with the help of this particular chart, right? This particular flow chart, let's understand. So friends, basically let's dive into how export financing is classified as NPA. So in the left side you will see post shipment credit supplies credit. I think you are familiar with this post shipment credit. So this is a common credit used in international trade after the goods have been shipped but before payment is received. That is called post shipment. Yes, good has been shipped but payment has not received yet. In that case, exporter takes some types of credit from the bank. So suppose it is ECGC covered credit. You know ECGC, Export Credit Guarantee Corporation of India, right? So if ECGC covered the payment risk, it is crucial to determine if there is a default by the importer. Yes, so it is very crucial to determine whether the importer has defaulted or not. If it is, and also there is Exim Bank guarantee cum refinance, right? So if there is a default, the export import bank steps in to guarantee the payment. You can see, yes, suppose the importer has defaulted, then Exim Bank, right? Then Exim Bank steps in. The Exim Bank steps in to guarantee the payment. But the question is, how do we classify the advance in this situation, right? So you can see Exim Bank will provide a guaranteed amount, right, within 30 days of the guarantee invocation. So suppose you have invocated the guarantee, so within 30 days Exim Bank will pay the guaranteed amount, right? And if the payment is not received from the importer, the advance is immediately classified as NPA, right? So remember, now suppose the payment is not received from the importer, advance is immediately classified as NPA. But one thing is important. To the extent of the payment received from the Exim Bank, advance not classified as NPA. Like suppose 1 crore was the outstanding amount, out of which Exim Bank guarantee suppose 60 lakh. So this 60 lakh is not to be classified as NPA, but only the 40 lakh which is not been provided by the importer, right, and which is not guaranteed by Exim Bank, that will be classified as NPA. That is a key point, and this will help you in solving the questions. This is very important thing, right? Now friends, let's look at the right side. Then in the right side we have export project finance. So basically now if there is a political issue, suppose payment issue is there due to a political issue, such a payment not being remitted due to political factor, the classification will be different. Try to understand. If the payment is if the payment issue is due to political reason and the payment is cleared but not remitted, it will not be classified immediately as NPA, right? Payment is clear but is not remitted. You know what the meaning of it? So it means payment is clear but not remitted. Then in that case it will not be classified immediately as NPA. But if there is no such issue and the payment is not remitted, the advance will be classified as NPA right away, right? So this is the point. So payment clear but not remitted, right? Then we have one more thing, that lending bank has to provide proof that importer payment was cleared in full. Only then asset can be classified as an NPA, right? That is the point. So this is the point. This ensures clarity and transparency in the export financial transaction. And one more thing, if the importer country prevent remittance classification, right? If the importer country prevent the remittance of payment, this create a situation where the payment might be delayed by more than a year from when it was deposited, and this also leads to NPA. Suppose importer country prevent remittance due to because of any situation, then in that case also it will be classified as NPA. So remember, when payment are delayed or not received on time, there are a specific factor like political reason or delays in the remittance process that can affect the NPA classification. I hope that makes sense to you. Now friends, let's look at the credit card, right? So friends, if we talk about the credit card account management and asset classification, so let's talk about it. There is something called credit card billing. I think you are familiar with this credit card billing. See, the billing cycle for credit card holder happens every month. So credit card billing refers to the process of generating your monthly statement, where you can see all the purchase, all the payment, and the total outstanding amount, right? So in that billing statement, you will see all the kinds of purchase you made, all the kinds of payment you have, and the total outstanding amount, to avoid any late fee. If you look at the payment option we have, so basically credit card offers payment option. You can choose to pay the full amount. Yes, either you can choose to pay the full amount, or you can choose to pay the minimum amount, that is called MAD, that is called minimum amount due, right? So it is, so full amount, if you choose to pay the full amount, no interest charge if paid in full. And if you choose to pay the minimum amount due, that is MAD, what will happen? A minimum portion of the total bill that you must pay to avoid the late fee. Or if there is something called balance rollover, which means the remaining balance carries over and the interest is charged on it. Yeah, right, remember it. So balance rollover means interest is charged on the balance that will be carried forward. That is the point. Now friends, make sure to pick the best payment option for you depending on your financial situation. So there are these three options, those two options are there. Now if you look at the NPA classification, credit card account are classified as NPA if minimum due amount remain unpaid for 90 days. So remember, if the minimum amount due is not paid for 90 days, then it will be classified immediately as NPA, right? So if you are unable to pay for 3 months, your account can be flagged as NPA, which negatively impact your credit score and future loan eligibility. Remember, obviously, if it is NPA, your credit score will deteriorate, will decrease, and obviously your future loan eligibility will also be hampered. Now friends, let's look at the credit agencies. Friends, that your credit history is reported to credit agency. Any overdue, any NPA account will be reflected in your credit report, which could affect your ability to get loan in the future. It is essential to maintain a good payment record to keep your credit score healthy. There is something called panel charge. What is the meaning of panel charge? Basically, if you are late in paying your credit card bill, there are penalty charge added to your account. This can increase your total outstanding balance and make it harder to pay off. Always aim to pay on time to avoid this kind of charges. Now friends, if you talk about the loss asset write-off, very very important point. Basically what it is, suppose when a credit card account goes into NPA, suppose there is a credit card account, it goes into NPA status, right? So the bank may write off the asset. The bank may write off the loss if they deem the debt uncollectible. Remember, so 100% provisioning the bank have to do. Loss asset are typically written off completely, meaning bank recognize that recovery of debt is not possible. This is very very important. Loss asset are written off completely, means the bank is sure, bank recognize that no recovery of debt is possible now. Now let's look at the provisioning for doubtful asset. Very very important thing. So you know that for doubtful asset that may eventually turn into loss, the bank keep a provisioning, meaning they reserve fund to cover potential loss, and the provision for doubtful asset is determined based on how long the debt have been overdue and the likelihood of repayment. So for unsecured account, 100% provisioning. For secured, 25 to 100% depending on the types of doubtful, D1, D2, D3 as it is, right? So that is the point. Now friends, I will tell you the exact trick to remember it, right? How to remember this kind of trick. I will explain, right? So before that let us take to the next point, that is loss. So here we are talking about something that we call as loan provisioning requirement in the case of in banking, right? So here we are talking about loan provisioning requirement in the case of banking. So as you can see, friends, just wait a minute, let me bring it back, just a minute please. Yes, now I hope I can continue the session. Sorry for the inconvenience caused, friends. Now friends, let's look at the loan provisioning requirement. So what does it mean when I say loan provisioning requirement? So as you can see that basically what is loan provisioning? Loan provisioning is the process where banks set aside a certain percentage of fund to cover potential loan loss. This helps ensure that bank remain financially stable. So in this table you will have understand everything. So in the flow chart we can see that different loan category require different provisioning. So let's start with the farm credit and SME, right? So farm credit and SME are small and medium enterprise, right? They are considered to have relatively lower risk, so the provisioning is just 0.25%, right? So then we have the CRE means commercial real estate. So they are a bit more risky, so that is why provisioning requirement is 1%. So commercial property can experience market volatility. making it riskier investment for the bank. If you have commercial real estate residential housing sector, then it is slightly lower provisioning 0.75%, as these loans are generally more stable than commercial real estate project. Then we have something called teaser housing rate loan. You should remember all this provisioning, very very important, right? Teaser rate housing loan. So teaser rate housing loan is attractive loan where initial low interest rate with later increase after 10 year. So due to potential for default after the initial period, this loan require initially 2% provisioning, right? After 1 year, the risk reduced to 0.40, and so provisioning is just 0.40% provisioning, right? If we have restructured advance, so loan that can be restructured, right, and to basically restructured to give borrower more time to repay, fall under this category, and the provisioning requirement is 5%. What about the natural calamity? So also there is 5%. What about the other loan in advance? So other loan in advance, it is 0.40%, right? For other loan in advance, the provisioning requirement is 0.40%. These are a standard loan, not falling under the category we discussed earlier, right? So that is the importance of this provisioning. Now friends, loan provisioning help banks safeguard against potential loss from loan default. Now let's look at PCR. PCR is an essential tool for ensuring that banks stay financially stable and prepared for potential loss. So PCR is a measures that help banks set aside sufficient provision for potential loss that could occur due to NPA. So you can think of it like safety cushion for bank to absorb financial shock. So if you look at this macro-prudential approach, let's look at it. What is the meaning of it? So this is the key part of PCR, right? So this macro-prudential approach tells bank to build provisioning and capital buffer during good time, right? So this approach tells that banks should build provision and capital buffer in good time, right? Which means setting aside enough money when the economy is doing well. That means they set aside enough money when the economy is doing well. So this help absorb loss during downturn or economic slowdown, right? So understanding loan provisioning is crucial for both bank management and regulatory compliance also. Now friends, if you look at the definition and purpose, so the primary goal of PCR is to ensure that bank have enough provision to cover the potential loss due to gross NPA, which is called non-performing asset, right? So what is the full form? What is the formula for PCR? In the numerator, we write the actual provisioning we have done, and in the denominator, we write what? We write the gross NPA, right? Again, I am repeating. In numerator, just write the provisioning, and in the denominator, you write GNPA, gross NPA, multiplied by 100 to get percentage, right? So essentially, PCR is like a rainy day fund for bank. What is the meaning of rainy day fund? So it is just like a rainy day fund for bank, right, to cover any unpaid loan or bad debt. The purpose is the financial stability. And one more thing is that post implementation status. So as per RBI, right, there is a target, right? So let me first of all talk about the target. The RBI has set a regulatory requirement for bank to achieve 70% PCR target. So this is not a suggestion, it is a mandate to make sure that banks are ready for any potential NPA or loan loss situation. If the bank PCR is below this target, they need to ensure provision to ensure they meet the target, right? Or they have to increase the provision. That is the point. So one more thing, that if you look at the post implementation status, as of now 70% of the banks have achieved the target. Majority achieved, many of them has achieved the 70%, right? So this means that bank have successfully set aside enough fund to cover potential loan loss, and RBI regularly monitor it. That RBI review, this is very important. Now friends, let's switch our focus to this very important table from where questions are asked every year. So what is the meaning of this table? Let's understand. So what is the meaning of incremental provisioning requirement? You see this word written here, incremental provisioning requirement. So provisioning is when banks set aside money to cover potential loss from bad loan or exposure, and the incremental provisioning requirement refers to how much additional provision is required when the likelihood of a loss increase based on certain threshold. So loss likelihood is based on certain threshold, then how much extra provisioning required. So take a look at this table that explains the likely loss percentage versus the incremental provisioning requirement, right? So here you can see likely loss upon EBIT, earning before interest and depreciation, right, on the total exposure. So up to 15% likely loss upon EBIT ratio, right? So what happened that if it is just 15%, if the likely loss percentage is less than or equal to 15%, the bank does not need any additional provisioning over and above the standard asset provisioning. So in this case, there is no incremental requirement, right? But if the likely loss go over 15% but up to 30%, right, the bank will need to make an additional 20 basis point provisioning to cover the potential loss. And if it is if the likely loss percentage is between 30 to 50, then 40 bps is required. So one thing you can see, if 30 to 50, just 40, it is midpoint. 50 to 30, 20, right? Then 50 to 75. So suppose if it is 50 to 75, then at this point risk increases significantly. The bank must make an additional 60 bps. This is the additional incremental provisioning. The bank must make 60 bps provision, and when the likely loss is more than 75%, the bank must set aside the maximum additional provisioning of 80 bps. Why is this important? Because this incremental provisioning requirement is very crucial. It helps bank better manage credit risk. It ensures that bank remain financially stable, right? So let me give you one example. Imagine a bank that has a large amount of exposure in loan to a particular sector, like say foreign currency, right? If that sector is facing challenges and the likelihood of loss from those loans increase, the bank will need to make higher provision. So based on the likely loss percentage, this is called likely loss percentage. Based on the likely loss percentage, the bank decide how much additional capital it should reserve. And for those who have enrolled in our course, I want to tell you, I provided you a separate case study based on them. This is the most frequently asked question. Please go through this case study. Make sure that you practice those case study before going into examination, because you will get similar question in the examination. I have added that case study in our crash course also, right? Now friends, let's look at the last point, that is SMA category, right? Very, very important. What is the meaning of SMA? So basically, a special mention account are a category of loan that are not yet classified as NPA but show sign of financial stress, right? So SMA are classified into three categories based on the duration of overdue payment. If it is term loan, right? So remember, if SMA 0 means in the case of term loan, SMA 0 means that the loan payment is overdue for 1 to 30 days, right? So at this point it is just a minor delay and the loan is still considered in good standing. If it is overdue for 31 to 60 days, right? If the loan payment is overdue for 31 to 60 days, it becomes SMA 1, and if it is 61 to 90 days, it becomes SMA 2, right? So remember, this is for term loan. And if you talk about the revolving credit like CC or OD, this is called revolving credit. What happened in that case? So for revolving credit, the SMA 1, if outstanding balance exceed the sanction limit for 31 to 60 days, and SMA 2 for 61 to 90 days. That is the classification for revolving credit. Remember these two classification. And if you talk about the credit reporting, what does it mean? That what is the meaning of credit reporting? Credit reporting means bank need to report this account to CRILC. Which account? Which account where aggregate exposure of 50 million and above, means 5 crore and above. So those account where aggregate exposure is 5 crore and above, bank has to report to CRILC, right? CRILC, two kinds of report are there. There is CRILC main report, there is CRILC default report. If you talk about the main report, this is submitted monthly to track all SMA account. If you talk about the default report, this is submitted weekly. Remember, CRILC default report is submitted every week, right? So it is submitted weekly, especially if there is a default in payment or overdue loan. So this report is critical for timely identification of the potential NPA, right? So friends, that is all you need to remember from this particular chapter. And one more thing, I want to tell you the provisioning for all kinds of asset. So there is a trick to remember it. So let me tell you the trick, how to remember the provisioning for all kinds of asset. Standard provisioning, normal provisioning I'm talking about. So what you will do, you have to draw this particular table. Just let me tell you the trick to remember it very easily, right? So again repeating. So here you will write, just let me draw it here. So this is the account category. Here we have secured, here we have unsecured, right? And let me draw one more. So now this is SS, this is substandard. SS means substandard. This is D1, this is D2, this is D3. Now you have to remember the provisioning. Just write here 100, 100, 100, 100. Is it okay? 15, 25. Just put this 25 here. Just add these two. This you will get 40. And this is the provisioning, normal provisioning. And accelerated provisioning, there is a separate. But I make sure that if you watch the complete video of this crash course, especially for this particular unit, the question from where the repeated they are asking, that will be covered. So let's get started. And our first concept is source of liquidity exposure. So when we talk about the liquidity risk, we are referring to the risk of a financial institution being unable to meet its short-term obligation. Remember, whenever we are talking about liquidity risk, it just means what? So here you see the word written here, liquidity exposure. It simply means that our financial institution is unable to meet its short-term financial obligation. And why it is unable to meet short-term financial obligation? Because of lack of liquid asset. Yes, it don't have the liquid asset that much. That is why it is unable to meet the short-term financial obligation. Let's break this down into two major internal category. There are two major internal category of it. So first of all, you will see here internal liquidity risk. So what is the meaning of internal liquidity risk? So remember, whenever I say internal liquidity risk, this type of risk is institutional specific. You see written here, institutional specific, which means it is influenced by how a bank or financial institution is perceived in different market, right? So that is called perception in different market. So whether local, whether regional, whether national, or whether international. Simply put, it is the risk that a specific institution will struggle to get the money it need to run its operation. So that is why it is called institutional specific. That means a specific institution like a specific bank that will struggle to get money if it struggle to get, it will struggle to get the money if it needs to run its operation. This is called internal liquidity risk. And the other hand, we have something called external liquidity risk. You can see it here. So when does external liquidity risk happen? So it happen when external factor that is beyond the bank control impacts its liquidity. There are some external factors which are beyond the bank control. These factors are not under the bank control, right? And if such factor impact the bank, right, then this is called external liquidity risk. So external risk can include things like market disruption or changes in the financial system that can affect a bank ability to get money when needed. Now friends, let's talk about the categories of liquidity risk. Here you can see categories of liquidity risk. The three main categories are, let's explore the different types of liquidity risk that the bank face. First is called the funding risk. So what is the meaning of funding risk? This simply means risk of not being able to raise money. Yes, bank is not being able to raise money, and this kind of risk is called funding risk. Yes, it is unable to raise the money, and so it is unable to raise the money from the external source. Bank is unable to raise the money from the external source, right, when required. And the second type is called time risk. Time risk happen when bank is unable to match the timing of its cash inflow and outflow. When the name itself suggests, so bank is unable to match the timing of inflow and outflow. This is called time risk. Again I am repeating. So whenever bank is unable to match the timing of inflow and outflow, then time risk happen, right? So friends, and the third type is called the call risk, right? So we will talk in detail about this call risk, what it is all about. So tell me, when call risk happen? So call risk happen when loan or other obligation are called or earlier. So let me talk about call risk. So call risk happen when loan or any other obligation, they are called earlier. That is why the name is called call risk. So whenever a loan is called earlier, right, it's called earlier than expected, which can create a sudden liquidity gap, this kind of risk is called call risk. Why it is named call risk? Because they are called earlier, right? Friends, if you don't want lengthier video, if you want shorter understanding, shorter video, just 30 to 40 minutes you clear a particular chapter, then this crash course is most useful for you, because we just provide you only that information which from where questions are repeatedly asked. This will cover almost 50 to 60% of your syllabus. So we are talking about call risk. It happened when loan or other obligation are called earlier than the expected, so which can create a sudden liquidity gap, right? So this is called the call risk. Now friends, if we talk in detail about this other risk associated with the risk management, so there are some other risks also, as you can see. So basically, if we talk about the types of liquidity risk, we have already seen, right? Now funding risk, time risk, and call risk, we have already seen. And if we further categorize the funding risk, you can see the first is called fraud. Yes, fraud is a kind of funding. So question may be asked, which of the following is a part of funding risk? So if we talk about the fraud and systemic risk, so what is the meaning of systemic issue? So broad financial or economic problem affecting multiple institutions, that is called systemic risk. So there is a broad financial, basically a problem which is affecting more than one institution, making liquidity harder to access. This is called systemic risk, right? So this is called systemic issue. On the other hand, what we have loss of confidence, which means when customer loses confidence, it leads to run on deposit. About by bank run, it leads to run on the deposit, decrease in value, affecting their, so basically causing a liquidity crisis. So these three, remember, fraud risk, systemic risk, and loss of confidence, these three account for the funding risk. And I already told you what is funding risk. Funding risk just means when bank struggle to raise fund needed for its operation, and it is caused due to fraud, systemic risk, or loss of confidence. So we'll see what will happen when you will revising. You will just go through these points, and ultimately the main thing will strike your mind. So this flow diagram, this chart will help you revise the thing very easily, right? At the time of revision, this will help you surely. Now if you further categorize the time risk, we can see the two part here only, right? The first is called deteriorating asset quality, which means when a bank asset, what is the bank asset like a loan, right? Suppose a bank asset like loan decrease in value, affecting their liquidity. This is called deteriorating asset quality. Or the borrower default. Suppose the borrower default on the loan. The bank may not have enough liquidity to cover their obligation. This is called borrower defaulting. And these two things account for time risk. And time risk, I already told you that there is a mismatch in timing between cash inflow and the cash outflow, right? So banks are unable to match the timing of their cash inflow and outflow. So if the asset quality is deteriorating or if the borrower is defaulting, it will ultimately cause a time risk. So remember, the questions are repeatedly asked from this funding risk, time risk and call risk, and all of them are the part of liquidity risk. And finally, the call risk happen when call risk when it happen, then suppose the impact of financial instrument like swap and options, or conversion of non-fund based into fund based liability. Suppose what happened, that non-fund based limit may turn into fund based liability, like suppose like letter of credit is a non-fund based, like guarantee, bank guarantee is a non-fund based, and suppose I crystallize them, right? Bank crystallize them and they convert them into fund based liability. This is called, this can arise to the call risk. And the second example can be impact of financial instrument. So even complex financial instrument like swap and option, right? So they can contribute to liquidity risk if not managed properly. So to summarize the fact, we can say that managing liquidity risk is about balancing the internal and external challenge, right? So external challenge, we have geographical challenge, systemic issue, instrument specific constant are there, right? So let me talk about system. What is the meaning of systemic issue? Like broad financial or economic problem affecting multiple institutions. So basically, to summarize the fact, what we conclude, that managing liquidity risk is about balancing both internal and external challenge, making sure that bank can meet their obligation without running into trouble.
Let's shift our focus to the topic from where case studies are most frequently asked, and here we are talking about liquidity assessment breakdown. So friends, we are diving into the essentials of liquidity assessment in banking, breaking down key ratios that help determine how well a bank is positioned to meet its obligation. So first of all, the first ratio we have is called the core deposit ratio. What is the meaning of core deposit ratio? So this ratio measures the proportion of core deposit to the bank total asset. So in the numerator we write core deposit, and in the denominator we write TA. TA means total asset. So higher the ratio, the better the liquidity, because simply put, a higher ratio means more stable fund for the bank. So if the ratio is higher, it simply means that more stable fund for the bank, right? That is called the core deposit ratio. Second ratio we have is the net loan to deposit ratio. So it compares net loan to total deposit. And tell me whether this ratio should be lower or higher. Obviously this ratio should be lower, because if the ratio is low, it is ideal for liquidity, as it means that bank is not overly dependent on loan, right? If this ratio is lower, it simply means that bank is not totally dependent on loan, right? Giving them more room to cover short-term need, right? So this ratio should be lower for better liquidity, right? Then the third ratio we have is called the time deposit ratio. So this ratio evaluates time deposit in relation to the total deposit. So remember, in the numerator we write time deposit, in the denominator we write total deposit, right? And tell me whether this ratio should be higher or lower for better liquidity. It should be higher, because total deposit we are talking about. So higher ratio generally signifies better liquidity, since the bank has locked in fund for a certain period. That is called time deposit. What is the meaning of time deposit? It means the fund is not readily available, it is locked for a certain period. And since the bank has, this ratio is higher, it means time deposit is higher, and if time deposit is higher, it is good for the liquidity. Then we have something called volatile liability. So if we talk about the volatile liability ratio, as the name itself suggests, it will compare volatile liability with total asset, right? So it compares volatile liability. Now what is the meaning of volatile liability? Like some short-term borrowing. So short-term borrowing, if you borrow for short-term, this is called volatile liability. So it compares short-term borrowing with with total asset. In the numerator we write short-term borrowing, in the denominator we write total asset. And tell me whether this ratio should be higher or lower for liquidity. Think about it, because ultimately you have to think. Questions are most frequently asked with whether this ratio should be lower or higher. See, a lower ratio indicate that better liquidity. Why? Because the bank is not heavily reliant on short-term unstable funding, because these short-term borrowing are quite unstable, right? It can cause a big trouble to the bank liquidity, and if it is low, it is better liquidity indicator. Now the next ratio we have is nothing but short-term liability ratio. So this ratio compares short-term liability. See, in the numerator what we write? Again, in the numerator we write short-term liability. In the numerator we write short-term liability, and in the denominator we write liquid asset, right? In the denominator we write liquid asset. Now tell me whether this ratio should be higher or lower. So it should be lower because short term liability you can see, right? This ratio should be lower for better liquidity, because it shows that bank can meet its immediate obligation with easily accessible asset, because denominator is what? Denominator is liquid asset, right? So if this ratio is lower, it simply means that bank can meet its obligation, which is the immediate obligation, with easily accessible asset, which is the liquid asset. Liquid asset is easily accessible, so that is why this ratio should be lower. That is called short term liability ratio. Then after we have liquid asset ratio. You know the meaning of liquid asset ratio? Liquid asset ratio simply means in the numerator we write liquid asset, in the denominator we write what? Total asset, right? So how much liquid asset is as compared to the total asset? So a higher ratio is better, as it shows the bank has more cash or asset that can be quickly converted into cash. What is the meaning of liquid asset? So those kind of asset that can be quickly converted into cash are called. This particular liquid asset ratio, it measures liquid asset as compared to total asset. So a higher ratio is better, as it shows that bank has more cash or asset that can be quickly converted to cash. Then we have prime asset ratio. Prime asset ratio compare prime asset with respect to the total asset. What is the meaning of prime asset? Prime asset means highly marketable asset, right? So high quality, easily marketable asset. There is a high quality liquid asset. You might have heard of SQLA. So this is called prime asset. High quality liquid asset, that is called easily marketable asset. So it compare high quality asset to total asset, right? So a higher ratio indicates that the bank hold more high quality assets supporting its liquidity position. And then we have market liability ratio. So this ratio look at the proportion of market liability, that is what is the proportion of market liability with reference to total asset. What is the meaning of market liability? It means short term borrowing. What is market liability means? Short term borrowing, right? So this ratio should be lower. Why? Because it means the bank rely less on borrowing from the market for its liquidity. So see, market liability simply means short term borrowing. So if this ratio should be lower, because ML is lower, ML means short term borrowing is lower, it indicates that bank rely less on borrowing from the market for its liquidity, right? So friends, the goal is to ensure a balance of high liquidity ratio, which means the bank can easily meet its obligation and safeguard its financial stability. So monitoring this ratio help prevent liquidity crisis and strengthen the bank position. And this is called a stock approach of measuring liquidity. There is a second approach which we call flow approach. Till now we have talked about the stock approach. So friends, this is the essence of our crash course, that you get to understand each and every point in a less amount of time, and you have to practice more. See, our main motive is that you have to devote 80% of your time toward practice and just 20% of time toward learning theory, because ultimately practice will only help in BFM. You have to expose yourself to different types of problem, and that is what we do in our quizzes portion, right? In the quiz portion, I provide you exposure to different types of case studies, MCQs, which are most frequently asked. Now friends, let's switch our focus to the alternative scenario in the liquidity management. So friends, let's understand the alternative scenario. So there are three key scenario basically. The first is called general market condition. So in this scenario, the bank is operating under normal operation, right? Normal condition where everything is flowing smoothly. So whenever I say normal condition, everything is flowing smoothly. That is the meaning of normal operation, right? Means including cash operation, including debt management, including rollovers. Everything is happening smoothly. So the goal here is to maintain consistent liquidity and ensure that all market and operational rate are met without any disruption. That is called general market condition. Means everything is flowing smoothly, right? That means cash operation, debt management and rollover. Goal is to maintain the consistent liquidity and ensure that all market and operational needs are met without any disruption. So think of it as business as usual, where liquidity is stable and the market conditions are favorable for a smooth operation. That is called general market condition. Second case, we have the general market crisis. See what happened. This is where the things take a turn. A system-wide banking crisis causes market disruption, right? A system-wide banking crisis causes market disruption, right? Liquidity gap and issue with the credit tiers. What is the assumption here? Assumption is that the banking system face widespread challenges, right? The banking system face widespread challenges, including difficulties in getting credit, liquidity shortage, and a lack of market stability. So what is the implication? So these are the assumptions. Again, I am repeating. The banking system face widespread challenges. It face, difficulties in getting credit. It is not getting credit. Liquidity shortage is there, and lack of market stability is always there. These are the assumptions under general market crisis. What is the implication? The implication is that the entire sector faces liquidity problem, and the large institutions are particularly more vulnerable. that is called general market crisis. And the third crisis is called, bank specific crisis. So basically what happened in bank specific crisis. Now one more thing I want to tell you, how to mitigate the general market crisis, how to mitigate it. So in order to mitigate it, right, what we need to do to manage this risk, a sector liquidity buffer. Right, here you can see the word sector liquidity buffer. A sector liquidity buffer can help. It is like a cushion that bank can fall back on during turbulent time. And the bank specific crisis. In this scenario, the crisis is not systemic but specific to one bank. See, in this case it is systemic, means every bank is facing, entire financial institution is facing. But in this case it is bank specific, right? So the bank face some internal issues. The bank face some internal issues such as difficulty in refinancing or no external help available for a rollover. What is the assumption? Assumption is that bank might be having trouble in renewing its loan. Right, there is a trouble in renewing its loan. Rollover means what? Renewal. There is a trouble in the renewal of the loan. There is a trouble in the achieving credit facility, which leads to liquidity crunch. How to mitigate it? So to mitigate it, the bank need to implement the supervisory measure, and they rely on the liquidity buffer to manage that situation and to stay afloat. It's like a personal emergency for the bank, and it must depend on its own resource to get back on track. So what we learned from this discussion is that liquidity management is crucial for maintaining stability, whether the market is operating normally or whether, you can see in this condition also liquidity management is required. In these two conditions also liquidity management is required. So these are called alternative scenarios. So what we get to learn from this discussion is that liquidity management is very crucial for maintaining stability, whether the market is operating normal or whether it is facing a crisis. Understanding and preparing for both general market crisis as well as bank specific crisis, it can help bank ensure that they are ready to handle unexpected situation. Understood? So whether it is about having a sector liquidity buffer, here you see where we have a sector liquidity buffer, and whether we are having a internal liquidity measure, right, for bank specific crisis, effective management can make all the difference. That is what the role of liquidity management is here. Now friends, let's switch our focus to our next topic, which is more and more important. If you really think that this is helpful to you, please hit a like button. This will motivate us to make more such content for you, because it takes lots of effort to prepare such kind of slides from your Macmillan book, that is pointing each and every important points, right, figuring out, sorting out each and every points and presenting it before you. Now friends, let's talk about net funding requirement. Here we are going to explore the field of nets, how net funding requirement are measured and managed within the bank. Yes, we are going to talk about measuring and managing the net funding requirement, a crucial part of maintaining a bank liquidity. Let's break it down into three major areas. The first thing is called liquidity management. Liquidity is the key. Every bank need to ensure that it has enough liquid asset to meet its obligation under different conditions. The idea is to always have a cushion to weather any financial storm, whether it is market fluctuation or unexpected withdrawal. Then comes maturity ladder. So whenever you see this maturity ladder, you are talking about flow approach. Right, I told you about a stock approach earlier, ratios. Now maturity ladder means what? It's like the bank roadmap to financial health. You can think of like bank roadmap to the financial health, right? It compares future cash inflow with the cash outflow. Two things are there: future cash inflow versus cash outflow. What is the meaning of future cash inflow? Means that those money that bank will receive. And what is the meaning of future cash outflow? Means money the bank will pay out. So it compares both inflow and outflow over a specific period of time, over a set time frame, right? So this help bank understand when and how much money will come in and go out, so that they can plan ahead and avoid liquidity shortage. That is called maturity ladder. And I have prepared a special case study for understanding it. If you enroll in our comprehensive course and on our BFM course, you will get a detailed case study on the maturity ladder. There is a case study which is most frequently asked, and we don't have time right now to explain that. We have already covered in that particular lecture. Why I am telling you, because those who have enrolled in our crash course should also look that case study, where we have explained each and every point regarding this maturity ladder, how to go about solving a problem based on maturity ladder. Now friends, the second aspect to it, we have cash inflow and cash outflow. See, cash inflow means those funds that are coming into the bank, right? So can you tell me from where fund can come into bank? Like suppose some asset is maturing, right? Like loan that have been repaid, or some non-maturing asset has been sold, like property has been sold, or availing credit line. Suppose someone is availing something called credit line, right? So credit line are like extra fund available for lender. So there are some extra fund which is available for lender that are called credit line. So these are called cash inflow. And what about the cash outflow? What is the meaning of cash outflow? So whenever I say cash outflow, means these are the bank liability, right? Cash inflow are the bank asset, and cash outflow are the bank liability, meaning money the bank has to pay out in the future. Like it includes contingent liability. Remember it. Contingent liability is a kind of
cash outflow. What is the meaning of contingent liability? Like debt that might arise in the future. Like suppose there is some credit line. So you know, credit line is a kind of contingent liability because it may arise in the future. Or suppose there is some liability which is falling due, such as loan payment or vendor debt. These are called cash outflow. So basically, key takeaway from this discussion is that, you know, effective management of net funding requirement help bank prepare for the future, ensuring that they have enough cash to cover both expected and unexpected needs. It is a critical process to maintain balance between liquidity and financial stability. So by using, these are the tools. By using tools like maturity ladder, bank can anticipate their cash need, reduce the risk, and avoid the liquidity crisis. So in the flow approach, we use a very important tool that we call maturity ladder approach. So just now we have talked about stock approach, we have talked about the flow approach. Now let's see this particular table. So let's talk about it. So friends, let's dive into an important topic in the liquidity management, that is measuring liquidity over the chosen time frame. So why this important? Because, you know, the main purpose of this is to track the liquidity position of a bank or an institution over the time. By doing so, bank can ensure that they have enough cash flow to meet their obligation and make sound financial decision. So the first question is, how is liquidity measured? Yes, obviously, how do we measure liquidity? This is the first question. So, you know, there is a way to measure liquidity, that, you know, cumulating cash flow. This is called cumulate cash flow. The first step is to gather and sum up the cash flow over the chosen period. Yes, we have a certain chosen period, like say 1 day to 1 year. Right, within this chosen period, we will cumulate the cash flow. We will sum up the, cumulating means summing up the cash flow. It just means summing up the cash flow. Right. So these cash flow could be from various sources, including deposits, loan, interest payment, and so on. Then the second step is, when the cash flow are cumulated, a liquidity graph is prepared. Right. This graph shows the inflow and outflow of fund. This graph shows how much inflow and how much outflow of the fund. This is called liquidity graph. Right. So helping visualize the liquidity position over the time. And then we analyze the bank scenario, which means we analyze different bank scenario, how the bank liquidity will perform under various circumstances. For example, what happens if the bank faces a sudden increase in withdrawal or has to deal with economic downturn. So the key consideration here is, you know, the chosen time frame for analysis plays a significant role. Are we looking at short term or we are looking at long term? That is called time frame consideration. Yes, whenever we are analyzing the bank scenario, time frame consideration is very, very important. And you know, there is something called short term management, means it focuses on meeting immediate liquidity need, like handling daily withdrawal. And if we talk about long term decision, like it helps the bank plan for future liquidity need, like expansion or investment. Besides, you know, besides all these, there are some assumptions for cash flow. What are those assumptions? Let's see. When assessing liquidity, it is very important to make assumption about future cash flow. What kind of maturity, what kind of value do the bank asset hold? Right, that is the point. So you can see regarding asset maturity and value, regarding liability, stability and financing. Means similarly, we need to assess the stability of bank liability, that it is obligation such as loan repayment. So what are the liability for a bank? Like loan repayment, the bank has to pay some loan, repay the loan, or suppose some debt is there, debt is also a liability, right? So we also need to assess the stability of bank liability such as loan repayment and debt. And also, of course, they are off-balance sheet activity. Like, you know, consider any off-balance sheet activity such as contingent liability, such as guarantee that could impact the liquidity position in the future. So these are the assumptions for cash flow. And there are some other factors, like, you know, don't forget external influence like economic condition or policy change. These factors can have a direct impact on liquidity. So by measuring liquidity over a specific time frame and considering factors like cash flow assumption, asset maturity and economic condition, bank can make better decision about managing their liquidity. Right, now friends, let's see the last slide. I think one more important topic here. Let's talk about it. So backup liquidity for emergency situation. So friends, in any business, but especially in banking, preparedness for unexpected situation is very crucial. This is where backup liquidity comes into play. Yes, we are talking about backup liquidity. See, what is backup liquidity? Backup liquidity refers to fund that a bank keep aside to handle emergency. Yes, for emergency situation. It is like financial cushion that ensure a bank can continue to operate smoothly even when there is a sudden liquidity crunch. Try to understand it. RBI guideline for maturity bucket, very, very important. The Reserve Bank of India has provided guideline for managing liquidity based on maturity period of different assets. So whenever I say maturity bucket, it just means, you know, maturity of different asset, maturity period of different asset, like, you know, short term, right, medium term and long term. So when I say short term, it just means, you know, tomorrow to 1 month. This is called short term. And remember, this covers liquidity need for tomorrow, 2 to 7 days, 8 to 14 days and 15 to 30 days. This question is asked. So in short term, what kind of buckets we have? So we have 4 buckets: tomorrow, 2 to 7 days, 8 to 14 days, 15 to 30 days. Bank need to be ready for this short term demand to avoid any liquidity shortage. So that is called maturity bucket. Then in the medium term, we have 1 month to 6 months. So whenever I say medium term, it means 1 month to 6 months. See, this deals with liquidity requirement for the medium term. That means from 31st day to 6 months, right? So you can see it has been further categorized into 31 day to 2 month, 2 month to 3 month, 3 month to 6 month, and 6 month to 1 year. Is it clear now? No. Medium term is 1 month to 1 year, right? Not 6 months. And long term is over 1 year, right? Long term is over 1 year, like 1 to 3, 3 to 5, over 5. So question is asked, what are the different categorization of maturity? So you can see total how many are there? 1, 2, 3, 4, 5, 6, 7, 8. Obviously there are 10, right? There are 10 obviously. So friends, long term means liquidity needs for long term from 1 year above, right? Now that is the RBI guideline for maturity bucket. I hope it is clear now. Now friends, if you look at the source of emergency fund, from where this emergency fund will arise. So when facing liquidity challenge, bank can turn into emergency liquid source. So which are unused credit facility. So bank can tap into credit that is available but not used, or they can take credit line from central bank. So central bank provide emergency credit line to bank during their financial crisis, ensuring their ability to meet financial obligation. So having a well-structured backup liquidity plan ensure that banks are prepared to face any financial emergency without risking their operation. So by following the RBI guideline, right, and utilizing resource like unused credit, bank can maintain stability during turbulent time. I hope that makes sense to you, right friends? So that is about the backup liquidity. Now friends, let's talk about, I think there is one more slide. Yes, crisis management strategy. Let's talk about it now. So friends, let's talk about how crisis management works. So let's talk about how crisis management work and what strategy organization follow to handle tough time. So whenever a crisis hit, it is critical to have a clear game plan in place to manage the situation effectively. And the core purpose of a crisis management strategy is to develop and implement the game plan. You can see that is the purpose. So how can organization handle crisis like expert? So there is something called managerial coordination. A well coordinated team can make all the difference in a crisis. Clear communication within the management. You see, clear information flow, clear communication, right? Within the management is key to quick and effective response. That is where we ensure that everyone know exactly what needs to be done, who is responsible for what, and what decisions are being made. That is called defined roles and responsibility. So clear information flow help prevent confusion. Define role and responsibility, ensure that everyone is on the same page. Then we have the second part, that is adjusting asset and liability behavior. In a crisis, the usual operation of an organization can be severely affected. This means making quick decision about managing assets and liability to ensure that business can stay afloat. That is what we do. So we have to make some quick decision. So adjusting how asset and liability are handled during a crisis can protect the organization from further risk. It can improve. It is important to stay flexible and responsive to changes, right? Then we have what are the technique. So we can boost cash inflow, right, and reduce cash outflow. Cash flow is very vital during a crisis. One of the top priorities is to increase cash inflow and cut down on any unnecessary outflow. So increasing cash inflow can be done. How we can increase cash inflow? Can you tell me? So we can increase cash inflow through quick revenue generation, or we can liquidate some asset. Yes, liquidating asset is also a very viable technique. So we can liquidate some asset, right? Reducing outflow. How we can reduce cash outflow? So reducing outflow can involve delaying payment. Yes, we can delay payment for some time. This will reduce our outflow, or cutting cost temporarily. So these are the way to reduce cash outflow. And the last we have managing customer, lender and relationship. So a strong relationship with customer and lender are critical part during a crisis. You need to prioritize their need and keep them informed about how the crisis is being handled. So clear communication with the customer about delay or service changes can prevent loss of trust. For lender, maintaining open line of communication about financial stability is very important for ongoing support. And then we have prioritizing a stakeholder in crisis. Not all stakeholders are equal during a crisis. You need to focus on key stakeholders who are critical to survival. So prioritizing a stakeholder help manage limited resource more effectively, and strengthening lender relation. So lender relationship are especially important during a crisis. Strengthening those bonds ensure that business has financial support if needed. So to successfully manage a crisis, coordination, strategy and communication, these are the pillars of any successful approach. Every step matter, from cash flow management to building a strong relationship with your stakeholder and lender. So ever wondered how bank balance profit and risk? how do they maximize earning while ensuring financial stability? Let's bring simple and powerful way, right? So there are two things. On one side, on one side we have risk, right? And other side we have what? Return, or we will call it profit, right? And also, how do they maximize earning? So first of all, let's look at this particular diagram. On one side, let's look at the objective of the bank. So basically, at the heart of the banking lie a key mission. The mission is to profit generation. Yes, profit generation is the key mission of banking, right? But banks serve as an intermediary, right? Banks serve as intermediary, turning deposit into loan, and this loan fail. They turn deposit, whatever deposit they receive from customer, they turn deposit into loan, and those deposits fuel the engine of industries, trade, and agriculture. That is the point. Turning deposit into loan, and that turns engine of industry, trade, and agriculture. Now friends, let's look at the other part of it. The other part you can see is the investment strategy. What is the meaning of this investment strategy? Left part you can see that bank carefully design their investment strategy by balancing risk and reward. Yes, I already told you that risk and reward has to be balanced, and that is how they carefully design their investment strategy, right? So there are some low risk investment like SLR, right? Like those regulated under SLR, those investment which are regulated under SLR, they are safe, they are low risk, right? They offer stability but lower yield. Obviously, since stability is there, so yield is also lower. On the other hand, corporate debt and some high risk instrument there, they promise some great reward. The secret is that optimizing balance. This is the secret. The secret is to optimize the balance, right? To optimize the balance to maximize profit. Optimizing balance to maximizing profit while staying within the risk appetite. This is the secret that the bank follow. That yes, they optimize the balance, right? To obviously they want to maximize profit their profit, but staying within the risk appetite. That is the point. Now let's look at the next segment of it, that we have something called profit planning framework, and on the left side you can see it here, profit planning framework. Friends, let's see. A bank earning are not just from loans, right? They have multiple income streams, like through interest income. They have some interest income, right? Like interest incomes like through loan and bonds. There are some fee-based services they provide, like account maintenance and transactions, and treasury-based service, treasury operation. That means they're trading in forex, right, and securities. So these are the multiple incomes of bank, right? And if you look at the dual responsibility of bank on the right side, you can see. So friends, you can see that bank wear two hats. They act like a trustee. They act like a bank, act like a trustee, right? Ensuring fund safety with fixed return, right? And ensuring that your fund are safe. Whatever you deposit in the bank, it remains safe with fixed return. But here is the catch. They must also maximize profit, right? They must also maximize profit, right? While managing the risk. This creates a natural conflict. Obviously, a conflict get created, right? Making risk management and balancing the risk the key to success. So, risk management and balancing and balance the key to success. So, friend, the conclusion is that strategic profit planning in bank is all about striking the perfect balance. It's all about striking the perfect balance. That is called strategic profit planning. That is what we are discussing right now. So, it is all about striking the perfect balance between earning high return while maintaining financial security. If you want to dive deeper into the banking strategy, stay tuned, because in this way we provide you every content for each and every unit of BFM in a single chart, in single diagram. You will get to know every aspect which is covered in 2 pages of the book. If you go through Macmillan, 2 pages that have been covered in the single diagram, and every aspect have been discussed, nothing have been left out. So we have discussed the profit framework planning, we have discussed the investment strategy, objective of bank, and dual responsibility. Every aspect has been considered. Now friends, let's look at this diagram, and every aspect of this capital will be crystal clear to you after going through this diagram. This is the essence of our crash course, that we try to provide you every detail in a single diagram. This will be help you in the time of revision. When revising before the examination, you once see this particular diagram, everything will be recorded in your mind, and you can answer any question, whether it is theoretical, whether it is numerical, no matter what. So friends, managing risk in banking is an art, but how do bank measure risk and ensure that every investment bring the best possible return? The answer lies in risk capital and RAROC. Yes, the answer lies. What is the question? The question is, how do bank measure risk and ensure that every investment brings the best possible result. The answer lie in risk capital and RAROC. What is RAROC? RAROC means risk adjusted return on capital. So let's simplify this powerful concept. First of all, expanding the scope of risk capital. This is this part. So basically, risk is not just about credit. Bank must also consider the credit risk, which is the possibility of borrower defaulting, the operational risk, which the losses from failed internal process, and there is interaction between market and credit risk. Like suppose how market fluctuation impact lending. Now, so this is the expanding risk capital scope. Now let's look at how do bank calculate the risk capital. Let's look at it. How do they calculate the risk capital here? So basically, one of the most used method is called VAR. VAR calculation is the most useful method that we call value at risk to measure the risk capital, right? So what is the formula? It estimates the potential loss. The formula is RC is equal to notional amount multiplied by volatility. This sigma is called volatility, and multiplied by confidence factor. This 2.33 is called confidence factor. So corresponding to 99% confidence interval, the confidence factor is 2.33. We can also call it Z value. So this is the formula. First you write the notional amount, right? You write the notional amount, you multiply it by sigma, that is the volatility, and you multiply it by the confidence factor. This is how you calculate the risk capital, right? So for example, you can see, suppose an investor is there, right? Two investors are there. One of them traded in forex. He invested 100 million capital, and volatility is 12% in forex trading. And suppose we are trying to calculate for 99% CI, so it gives us 28 million. This is the risk capital for forex trading. And suppose another investor invested in bond, and in the case of bond, the volatility is just 4%, and suppose he has invested $200 million, right? In this case, you can see the risk capital is 18.64 million, right? So but simply knowing risk capital is not enough. Yes, we know how to calculate risk capital, just now I have told you, but simply knowing risk capital is not enough. So we have to look after the purpose of RAPM, right? Purpose of RAPM. Bank don't just look at raw profit. They compare performance relative to risk. So whenever I say RAPM, it means what? Risk adjusted performance measure. Means they compare performance relative to the risk. So the RAPM help in benchmarking. Benchmarking what? Benchmarking trader and business unit, right? This is where RAPM help. RAPM help in allocating. Allocating what? Compensation and reward. RAPM help in optimizing resource allocation. For example, let me give you one example. Suppose a forex trader is here. Here you can see. Suppose a forex trader is there, right? And suppose that he managed $100 million, right? Earning 12% profit. And a bond trader is there. He handled $200 million, right? He earned 4% profit. So, but which one is truly performed? Suppose he also earned 12% profit, right? Suppose he also earned 12% profit. So this 12% and 4% are the volatility of investing in trading and bond trader. Suppose forex trader invested $100 million, bond trader invested $200 million, and both of them get the same return. Let's say both of them get the 10 million return, right? But the question is who is performing better, right? But the question is who is performing better. So this is where RAROC concept comes into picture. How to find the RAROC? So what we will do to calculate RAROC, here you will see. So for forex trader, what we will do, we will see the profit. What is the profit? For both, profit is just the same. How much is the profit? $10 million. But are they performing the same? No. Someone is performing better, someone is performing weaker. Who is performing better? For that we use the concept of RAPM. Both are having the same profit, which is 10 million. So we write 10 million in the numerator for the both. 10 and 10, you see. In the denominator, we just write the risk capital. Just now we have calculated the risk capital. For forex trader, risk capital is 28 million. So we just write 28 million in the numerator. And after calculating the percentage, this gives us 35.7%. And for the bond trader, you can see that the risk capital is just 18.64 million. We just write here and get the percentage 53.6. So friends, in this case, what we are observing that bond trader deliver higher return per risk unit, isn't it? Bond trader, they is delivering 53.6% unit risk. They are generating this higher return. So making bond investment a safer yet more profitable option. So what is the final takeaway from this discussion is that RAROC is not just a formula. It's a game changer in the banking. It ensures that bank make risk smart decision, right? Bank make risk smart decision, balancing profitability and financial stability. So this is the quantification of the fact which we have discussed earlier, right? I just told you that yes, we have to calculate RAPM, but how do we calculate? For calculating RAPM, you know, although both are earning the same profit, whether you are investing in a trader who has invested in forex trader and a trader who has invested in bonds, both are earning the same $10 million. Yet you can see the RAPM tells you the clear picture who is providing you more return. And this is the quantification. So two formula you must remember. First one to calculate the risk capital, and second one to use the risk capital to calculate our risk adjusted performance. I hope that makes sense to you. Please hit the like button if you really think that it is adding values to your knowledge, right, this particular video. And if you want to get part of this crash course, you are just one call behind. You can WhatsApp me on this particular number. Let me write down the number here. Either save the number. For any CAIIB related query you can ask me, right? Or you can see the description section also, you will get the number. Now friends, let's switch our focus to internal capital assessment and RAROC framework. So in today's banking landscape, managing capital efficiently is no longer a choice, it is a necessity. Bank need to strike the perfect balance between risk and return to ensure stability and compliance. That is where the internal capital assessment, that is what we are going to talk about. Internal capital assessment comes into picture, right? Friends, and RAROC framework also comes into picture. So the core principle, what is the core principle? Let's look at it. And here you can see at the top you will see the core principle. Let me show you. This is what I'm talking about, core principle. Friends, at its heart, this framework is built on a standardized evaluation process. Yes, there is a standardized evaluation process, right? So it aims to align revenue with the associated cost of risk, right? That is called revenue cost risk match. It aims to align the revenue with the associated cost of risk, ensuring that bank optimize their capital allocation while maintaining financial stability. What is the purpose of this allocation? What is the purpose of this framework? The purpose is, you know, it links capital planning directly with the risk exposure. Capital planning, it linked directly with the risk exposure, right? It ensured compliance with the Basel regulation, right? Ultimately, making the bank more resilient. Ultimately, it promotes overall bank stability, safeguarding the institution against unforeseen financial shock. So that is the purpose of it. Now friends, after understanding the purpose, let's look at the RAROC framework. Talk about the RAROC framework. In the left side you can see, just let me show you, just wait a minute. Here you can see RAROC framework. So what does it mean? You know, the risk adjusted return on capital is the cornerstone of the model. It measures the risk by calculating the expected loss, right? It calculates the expected loss. What is the meaning of expected loss? Means those loss which can be covered by reserves. And also we have some unexpected loss, right? So what is the meaning of unexpected loss? So how do we manage the unexpected loss? By, you know, by holding capital. Either we hold the capital or we consider some factor like value at risk or time horizon or diversification or correlation. So this is how you know, we are basically measuring risk by calculating the expected loss and by calculating the unexpected loss, right? So this RAROC framework is the coordination of this model. This RAROC measure risk by calculating the expected loss and the unexpected loss. If you look at the implementation strategy, so here you can see the implementation strategy. Basically, so the bank distribute return based on the volatility of its portfolio. How they distribute the return? They distribute the return based on the volatility of the portfolio, right? Which drive capital allocation decision, right? This in turn determine the required return on capital, right? This in turn determine the required return on capital, striking the balance between the risk and reward. Now if you look at the key component of this capital assessment, right? So the assessment itself covered the three dimensions. What are the three dimensions covered by assessment? The first is called, you know, qualitative, means evaluating the bank strategy and culture. If you look at the qualitative evaluation, it look at the bank strategy, bank culture. Second is called quantitative, means analyzing risk metrics, analyzing ratios, analyzing financial figure. And finally the scope, means covering the business area, covering the product and covering the activities to assess the overall exposure. So basically these are the three key components, right? Basically this assessment covers three key dimensions. Now let's look at the risk aggregation policy process. Lastly, bank need to aggregate all form of risk, whether market, whether credit, whether operational, into a single comprehensive risk profile. They need to aggregate all form of risk into a single comprehensive risk profile. This involves scrutiny at the head office level, HO level, and summation or risk summation of risk using RAROC metrics, right? to ensure consistency and accuracy. So friends, by effectively combining capital assessment with the RAROC framework, bank can make smarter data-driven decision, boosting profitability while maintaining compliance and stability. So basically two things are there. One thing is the RAROC framework, other is the capital allocation, and this is how this internal capital assessment works. Right. Now friends, let's switch our focus to the RAROC methodology. Let's look at this particular point. Imagine running a business where every decision carry a certain level of risk. Would not it be great to have a system that not only measures profit but also tells you whether you are taking the right amount of risk? That is where RAROC comes into picture. That is called risk adjusted return on capital. You know, RAROC is the heart of risk and capital management. It helps bank and financial institutions evaluate their performance while considering risk, ensuring smarter and more sustainable decision making. Let's break it down into three key pillars. The first pillar of RAROC, is the risk management. It helps bank and financial institution every investment carry risk, right? From market fluctuation to unexpected event. RAROC help analyze the portfolio exposure. Yes, which means, right, what kind of risk the portfolio is exposed to, and then it helps calculate the volatility analysis and risk factor correlation, right, to ensure that risks are properly managed before making decision. Then comes capital allocation, the second pillar. So not all investment require the same capital. You know it very well. RAROC consider the confidence level. It consider the horizon period. It consider thereby it calculate the value at risk to determine how much capital should be set aside for each investment. That is called economic capital, right? And the last but not the least is the performance measurement. I told you earlier that we first calculate the risk capital, and based on the risk capital we calculate the performance measurement. Profit is important, but is it worth the risk taken? Using RAPM, the full form is, RAPM full form is risk adjusted performance measure. So using RAPM, right, and EVA means, economic value added, right? RAROC help assess whether a business is truly creating values. So higher EVA means better performance. And let me tell you what is the formula for EVA. It is nothing but profit minus capital times K. Remember this formula? The EVA is another economic matrix that is called economic value added. It helps you decide that whether an investment is worth risk taking, right? So the bottom line is that this RAROC is like a GPS for financial decision making, guiding business toward profit while staying mindful of risk. Would you like to see a real world example of how RAROC applies? Stay tuned, because we are just talking about that. Every aspect of unit number last 31 has been taken care of in this particular lecture. Now friends, let's look at this EAR approach. Very important thing, right? Friends, what if you could predict how much your earning might drop due to risk? That is exactly what the earning at risk approach helps with. It is a powerful method used by business, used by bank to assess how fluctuation in market condition like interest rate or cash flow can impact their income. Let's break it down. Let's first of all talk about the concept of EAR. On the right side you can see, basically it focus on cash flow and earning variability. What it focus on? Cash flow and earning variability, right? So basically it helps business analyze how much their profit could be affected by interest rate change and other financial risk. That is called interest rate risk analysis. Suppose interest rate is bound to change, how will this interest rate change affect their profit? It's like financial weather forecast, keeping you prepared for any kind of a storm. Now if you look at the analytical framework here, you can see on the right, on the bottom side. So EAR relies on historical data. It relies on historical data, right, and frequency distribution, right, to estimate potential loss. It provides you the loss earning at risk, right? It considers the tail risk. That means the extreme but possible worst case scenario. That is called the tail risk, right? Using a statistical measure like a standard deviation to quantify the uncertainty. And if we look at the risk limitation strategy, is that to control risk, business set a maximum loss percentage based on past income. They set a maximum loss percentage, means how much they can withstand, how much they can tolerate. That is called maximum loss percentage based on the past income, based on the current income, based on the market value. They seek some tolerance level. This ensures that financial shock don't push them into a crisis. And if you look at the direct impact on earning, just look at the last point here. Let me show you. Just wait a minute. Let me tell you. Just look at this particular last point, right? The direct impact on earning. So basically, EAR directly measure earning risk rather than capital volatility. This make it a go-to approach for business that want to protect their income without worrying about complex capital structure. It skips the capital volatility. It directly help you calculate the current earning risk. The limitation of EAR is that, every model has its flaw. EAR ignores changes in asset and liability and rely on subjective risk range, which means it may not always provide a complete picture of the financial risk. So EAR is simple yet effective tool to measure how external risk impact earning, but it should be used alongside other risk management strategy for a well-rounded financial shield. Now friends, the last topic we have, that optimizing profitability through a strategic income and expense management. So first of all, you see staff expense, which means these are the expenses that bank incur. A staff expense means salary and benefit paid to the employee. Interest income means revenue generated from loans and other interest bearing asset. Fee based, so basically it is an income part, right? Fee based income are there, right? Like income from service charge and other fee. Trading income is there, that bank buy and sell security and other asset. Interest expense is there. This is one of the major expense. So on right side you see the income, on the left side you see two major expense, which we are trying to covering. I will provide you such kind of slides, such kinds of mind map and flow chart, which help you cover each and every point in the shortest smallest time possible. After going through this particular unit, I request you to please solve MCQs and quizzes which I have added in today's folder. This will help you to check your understanding, whether you have understand concept or not. If you are able to get at least 60 marks, then very good, you are at the right pace. Then you can switch to the next unit. If not, then you again go through the theory portion. So I hope after going through this particular lecture carefully, then you can easily get 60% marks in the quiz. Let's get started. So friends, what is interest rate risk? First of all, let's talk about it. So imagine bank earning money from loan, but suddenly what happened? Interest rate change. This fluctuation affect net interest and income and net interest margin, creating risk for the bank. So you can see this word written here: volatility in net interest income and net interest margin due to interest rate change. What is this NII? What is this NIM? Let me explain. But the question is, what causes it? What causes interest rate change? The first reason is principal mismatch. When bank borrows short term but lend long term. Suppose bank is borrowing for short term, like suppose 1 year. Or the first cause of interest rate risk is what? The first cause is called principal mismatch, which means when bank borrows short term but lend long term. So suppose they borrow for short term for 1 year or 2 year, and they lend for long term, like suppose 15 year or 20 year. So this is the principal mismatch or maturity day mismatch, right? So when assets and liability don't mature at the same time. So these are the two main reasons of interest rate risk, either principal mismatch or maturity date mismatch. If you just look at the formula of NII, which is equal to rate sensitive asset minus rate sensitive liability. This is the formula for calculating net interest income. And if you want to calculate the formula for NIM, which is net interest margin, what we need to do? We have to divide the NII by earning asset. Divide NII by earning asset. This will give us net interest margin. So remember these two formula. This will be super helpful in your calculation. Now friends, let's shift our focus to the impact on bank. So friends, it directly hit profitability, and it can shake financial stability if not managed well. Now why is risk management important? If you look at the importance of risk management, so maintaining the prudent risk level ensure the bank safety and soundness, right? And how does the banking industry respond to it, to this interest rate change? So it directly affect so you can see the banking industry respond. It is profitability challenge, right? It is profitability challenge, but bank tackle it with with proactive risk management, right, to stay ahead. So the big question is, how can bank minimize this risk? How can bank minimize this risk, right? Let's answer it. We will track the answer of this particular question in the upcoming slide. So now let's switch our focus to understanding gap or mismatch risk in finance. So what is the meaning of this gap or mismatch risk? Let's uncover. So friends, bank deal with asset, that is loan, and liability, that is deposit. But when their maturity don't align, it create interest rate risk. I told you early that there are asset for bank and there is liability for bank. Asset means loan and liability means deposits. And when their maturity does not align, I told you that mismatch in maturity, this give rise to the interest rate risk, right? So now let's understand the gap. What is the meaning of this gap? So friends, that the difference in how quickly assets and liability are repriced, how quickly they are repriced, how quickly assets and liability are repriced, this difference, right, leads to interest rate mismatch, and it causes what? Interest rate mismatch. Again I am repeating, the difference in how quickly assets and liability are repriced leads to interest rate mismatch, and this can make or break a bank profit, and this is called the gap. Let me give you one example to make this concept more clear. Here you can see one example which is given to you. So friends, suppose a bank take 100 crore liability, right? 100 crore in liability at 9% interest rate, right, and 1 year maturity, right. If it uses this money to fund 100 crore in asset, to fund 100 crore asset, 10% interest rate, 2 year maturity. So suppose again I am repeating, 100 crore liability it has taken to fund 100 crore asset at 10%. So you can see interest rate are different and maturity is also different. So year one profit, if you look at the first year profit, how much is the spread? So liability is at 9%, asset at 10%, so spread is 1%. So that means 1 crore. This is the first year profit. What about second year? Second year uncertain. Why uncertain? Because the liability will mature, right? But if interest rate stay the same, profit will continue. But suppose the liability rate jumps to 11%. Suppose liability rate jumps to 11% instead of this 9%. What will happen? The bank faces 1 crore loss, isn't it? So basically, so this is the case. Now reverse scenario. Now let's reverse the scenario. Here you can see. Suppose what if the bank liability mature after the asset? Like suppose here in this case of only the maturity of liability is 2 years and the maturity of asset is just 1 year. What if the bank liability mature after the asset? So the risk flip. So what happened? The risk will flip, right? Now the asset may be earning lower interest while liabilities are locked at higher rate. So this is called mismatch. I hope this example give you a clear understanding of what is the meaning of this gap risk or mismatch risk, right? That means repricing difference is there. You see, assets are being repriced after 2 years, but liability is just repricing after 1 year. And this repricing, this change in the interest rate while repricing causes this gap risk or mismatch risk. So what is the impact? Obviously this can lead to gain or losses, profitability get impacted, right? The first point. And the second impact can be bank become highly exposed to fluctuation. So this way this is the impact of this particular table, this particular graph. You can see this particular mind map. So you can cover each and every aspect of this in just one single slide, and this help you in revision at the last moment before the examination. Now friends, let's switch our focus to the next topic, that we have understanding the basic risk. Let's understand the basic risk. We are discussing every type of example, right, possible. So now friends, you might think that if a bank matches its assets and liability, it is safe from interest rate fluctuation, right? You might think that. Suppose a bank matches its assets and liability, it is safe from interest rate fluctuation. But wrong, because interest rate does not always move equally. This creates basic risk. Whenever, right, where even with a matched gap, bank face profit uncertainty. Yes, even with a matched gap, right, bank face profit uncertainty. Right. So what causes basic risk? Let's look at the causes. The first cause is uneven rate response, which means uneven rate movement across different banking product, or NII. This cause what? Net interest income become unpredictable due to rate variability. Let me give you one example of this basic risk to make it more clear. Let's assume that interest rate fall by 1%. You can see. Let's assume that suppose interest rate fall by 1% across all assets and liability, right? Interest rate falls by 1% across the board. Ideally, the bank NII should improve by 1 crore, right? Ideally, the net interest income. Suppose bank is there with a negative gap of 10 crore. Already bank is there with 10 crore negative gap. Suppose interest rate fall by 1%. So ideally, bank NII should improve by 1 crore. But what actually happened? The actual rate movement you can see. Call money lending rate fall by 1%. Cash credit rate fall by 0.7%, saving deposit rate fall by 0.5%, fixed deposit rate fall by 0.4%. So instead of an improvement, NII deteriorates due to uneven the rate shift. This is the basic risk in action, right? So instead of improvement, a different assets category, the rate of movement in the asset category is different, and this causes the basic risk, right? So this is called unequal rate movement despite matched gap. Unequal. We can see all these assets have unequal rate movement. Someone is decreasing by 1%, someone is 0.7%. So this unequal rate movement, this causes something called basic risk. Remember this word, unequal rate movement. You will always remember it. Now friends, one more thing I want to tell you, that what is the implication of it. So gap management is not enough, right? Bank need a dynamic strategy. Dynamic strategy is required to handle rate fluctuation. And this non-parallel rate shift mean bank must constantly monitor and adapt their risk model. So what we learned from this discussion is that understanding rate behavior is the real challenge, right? So that is the point. That is the this is called basic risk. So what should we do to combat it? So to combat it, gap management is not enough, right? Banks need a dynamic strategy to handle rate fluctuation, because the fluctuation of rate in different asset categories is different. So we have just discussed two kind of interest rate risk. First one we talked about gap and mismatch risk. Second one we have just discussed, this was the basic risk, where rate movement was unequal, right? Now friends, let's look at the next point.
that is net interest position risk. What is the meaning of this NIP? So basically if we talk about the NIP, net interest position risk, so ever wondered how bank manage their earning in a world of fluctuating interest rate? So what is NIP? So bank earn interest on loan and investment but pays interest on deposit and borrowing. So when a bank has more interest earning asset than liability, suppose bank interest earning asset, suppose bank rate sensitive asset or interest earning asset is more than RSL, what will happen? It will face net interest position risk, right? But why does it matter? Obviously it will face net interest position risk, but why does it matter? Because if interest rate on asset changes but liability remain constant, it affect the bank earning, right? So remember, it only happen when bank has more interest earning asset than interest losing liability, right? That is the point. So basically what happen if the interest earned on asset changes while cost of liability remain constant, it affect our NII, net interest income. So this mismatch in interest movement can impact the net interest income either positively or negatively. Let's look at two cases. First case when it positively impact, and second case when it negatively impact. Let's try to understand. So what happened when positive net interest position? With a positive net interest position, suppose we have a positive net interest position, means our interest earning asset is more than interest bearing liability. So in this case, suppose if interest rate decline, right, what happened? NII get reduced, bank earn less on asset, leading to NII reduction. And suppose in this case, suppose we have positive net interest position, and in this case interest rate rise, what happened? That leading to NII expansion. So basically why does it matter? Because what is the impact of it? Because a large positive net position can be double-edged sword. Yes, remember, a large positive net interest position can be दो धारी तलवार बोलते हैं ना, double-edged sword. Why it is called double? You know this word? You might have heard of this word. Just let me write down. Double-edged sword, yes. So why? Because on one hand it boosts profitability. Yes, it obviously boosts profitability in the case when interest rate rise, but on the other hand it exposes bank to interest rate fluctuation. Managing the risk wisely is key to financial stability. So the real challenge for bank is striking the right balance. Too much risk can hurt, but the right strategy can drive profit. And in examination you will face similar kind of question. You should clearly know the difference between gap and mismatch risk, basic risk, net interest position risk. You should clearly know the difference, and that is what our main motive is through this crash course, that in a small amount of time, in a little bit amount of time that you have, almost 2 months you try to cover everything efficiently. What is the meaning of efficiently? That means your output, your efficiency should be high. That means 80% of your time should be devoted to practice, and just 20% of your time should be devoted to the theory practice. And this crash course video, it just takes you hardly 20 to 30 minutes, not more than that, so that the rest 1 to 1.5 hours you can devote toward question practice. You can practice as much numerical question, as much theoretical question as much possible, so that you can check your understanding level. And that is what we do in our crash course. The detail of crash course you can find in the description section of the video. Now friends, let's switch our focus to the next category of risk that we call embedded option risk. Friends, bank and financial institution love stability, but customer and borrower often exercise their option based on market condition. So this creates something called embedded option risk, a crucial yet often overlooked challenge. What is this embedded option risk? Certain financial products like deposits, loan, bonds come with built-in option that allow customer to make changes based on interest rate movement. But when they do it, it impact the bank net interest income. I told you what is the meaning of net interest income. So there are 3 cases. Let's look at the first case. The first case, deposit withdrawal, which means, when interest rate rise, suppose interest rate rise, what will happen? When interest rate rise, customer withdraw their low interest deposit, right? What did customer do? Customer withdraw their low interest deposit. Customer withdraw their low interest deposit and reinvest them elsewhere, right? So they withdraw their low interest deposit and they reinvest them elsewhere. So this forces bank to reinvest at higher rate, leading to something called reinvestment risk. Again, I am repeating. So interest rate rise, customer withdraw their low interest deposit and reinvest them elsewhere. So suppose you have invested in FD and this FD gives you just 5%, and now suppose interest rate has risen. So what you will withdraw the amount and reinvest them elsewhere. So this forces bank to reinvest at a higher rate, leading to reinvestment risk. Second case is loan prepayment. When interest rate fall, borrower repay their loan early to refinance at lower rate. Yes, they want refinance at lower rate, and since interest rate has fallen, so borrower repay their loan. So this reduces the bank net interest earning and affecting NII and long-term profitability. These are the 2 cases of embedded option risk. And third case is callable bond. What is the meaning of callable bond? When interest rate drop, bond issuer redeem bond early to refinance at lower rate, right? So that is called bond issuer. Those who have issued the bond, they redeem the bond early.
they redeem the bond early. So banks are then forced to reinvest the fund at lower yield, reducing overall return. So bank must anticipate and hedge against these risks using financial strategy like interest rate swap. You might have heard of IRS, interest rate swap, or duration matching, or diversified asset management. A small change in rate can make huge gain or loss. So in finance, it is not just about making money; it is about keeping it, right? So managing embedded option risk is the key to long-term success. I hope it is clear now. Now, friends, let's look at the next kind of risk, that is called yield curve risk. Very, very important. This is another kind of interest rate risk. Let's talk about it. Friends, interest rate don't move in a straight line, and that is what yield curve risk, that is where yield curve risk comes into picture. So this risk can impact a bank profitability, especially when short-term and long-term rate move unpredictably. So what is this yield curve? So let's look at the definition part first. So here you can see the definition. So basically, it is a risk that arises due to change in the slope and shape of the yield curve. So basically, there is a curve, and every curve you have, there is a slope of it. For every curve, there is a slope. Not only slope, it has a shape also. For every curve, there is a slope and the shape. So whenever there is a change in the shape and slope of the yield curve, whether from economic factor, RBI intervention, or market fluctuation, either due to economic factor, regulatory intervention, right, any of the factor, right, this yield curve can arise. So a shift in the yield curve can disturb the balance between asset and liability, affecting the profitability. So let me give you one example to make this yield curve risk more clear. I'm providing you an example. Let's see. Suppose XYZ bank fund 3-year floating rate loan with 3-year floating rate deposit. So you can see the maturity of both these liabilities and assets are the same, right? But both are repriced every quarter. Yes, repricing is happening every quarter. But here is what happened when the yield curve shift. So initial scenario, you can see deposit rate is 13.5%, right, and it is linked to 91-day treasury bill plus 100 bps, and loan rate is 16%. It is linked to 64-day treasury bill plus 300 bps. So total NII will be how much? It will be 250 bps. Just find the difference. Right, just find the difference between them. 16 minus 13.5, this will give you 2.5, or we can say 250 bps, right? And now suppose the yield curve invert. What is the meaning of yield curve inversion? When I say yield curve invert, it means that short-term rate rise, long-term rate remain stagnant. That is called yield curve inversion. So short-term rate rise. So what happened? This 91-day treasury bill rate, which is 13.5, it jumped to 14%, right? And 364-day treasury will remain at 13%. Now you see what will happen. The NII get reduced because now deposit is repriced at 14%, but the loan rate is still 16%. So the NII is 16 minus 14%, which is 2%. Which means in this case you can see NII drops to 100 bps, right? So it drops to 100 bps. So what does it mean? That profitability shrink. So this is how this yield curve will happen. Now what is the impact on profitability? What is the impact? So here you can see the impact, because there is a profitability issue, because lower NII means reduced earning for the bank, and obviously interest sensitive asset. What does it mean? That the gap between loan and deposit rates shrink, right? So this is the takeaway. The final takeaway is that bank must closely monitor yield curve movement and use risk management strategy like hedging, interest rate swap, and duration matching to stay profitable, right? So one more thing I want to tell you, that RBI can twist the yield curve by influencing government bond yield. Yes, this power remains with RBI, that they can twist the yield curve by influencing government bond yield. Yes, remember it. And yield curve shift affect the relationship between short-term and long-term interest rate, right? Now friends, after understanding basic risk, yield curve risk, net interest position risk, gap and mismatch risk, embedded option risk, the next risk we have is the price risk. What is the meaning of price risk? Every type of risk we are covering. Friends, ever wondered why the bond price drop when interest rate rise? This is called price risk, a major challenge for bank holding bond in their trading book. Let's break it down. First of all, let's go through the definition of price risk. So here on the left side you see the definition. So basically, price risk what is? So it is the risk of bond price fluctuation due to change in the interest rate. Suppose interest rate get changed, obviously bond price will fluctuate, and this risk of bond price fluctuation is called price risk, right? So one thing it very well, that bond price and interest rate move in opposite direction, right? So suppose interest rate increase, then what happen? Bond price fall. Or if interest rate decrease, what happen? Bond price rise. For example, let me give you one example to make this concept more clear. So here you can see one example. Suppose imagine a bank hold a 10-year 14% Government of India bond, right? So here you can see, suppose a bank hold 10-year, right? 10-year 14% Government of India bond, if market interest rate increase to 15%, so earlier it is just 14%, and if the market interest rate increase to 15%, right, the bond will sell at lower price. As in, a bank hold a 10-year 14% government of India bond, and if suppose the market rate increase to 15%, the bond will sell at lower price because the newer bond offer higher return. So obviously this newer bond which is offering 15% return, right, it is the new choice of the bond holder, right? So making the old one less attractive, and this is this is the price risk in action. So what is the impact of price risk on bank? If you look at the impact, you know that higher volatility, if volatility is higher, right, it means risk is greater, price risk is greater. Short term, so what happened, short term rate fluctuation can cause sudden losses, right? So short term rate fluctuation can cause sudden losses. Then the second point, is called, trading. So here you can see higher volatility means greater price risk. And trading book exposure is one more thing. What is the meaning of this trading book exposure? So basically, bank holding bond for trading face daily market risk, right? So some bank, they are holding bond for trading, they daily face this market risk. But there is a profitability challenge. Yes, profitability challenge is always there. Unexpected interest rate hike, right? Unexpected interest rate hike reduces bond value, affecting earning. So the question is, how do bank manage it? So basically, diversification is one way. Diversification is one way to manage this price risk. Holding a mix of bond with different maturity, or hedging strategy is always there, right? And duration matching is always there. So understanding price risk is crucial for bank and investor alike. Managing it well, it means better financial stability. So I hope this risk is clear. What is the meaning of price risk? Now friends, let's look at some interest rate measurement technique. What technique we have to measure interest rate? So bank face interest rate risk when changes in the rate impact their earning and economic value. But how do they measure this risk? Let's explore the most effective technique used by financial institution. The first technique is called the gap analysis. Let's look at it. So gap analysis help bank measure the impact of net interest rate change on NII by comparing ISA and ISL. Two things are there. I told you RSA, RSL, but now let's be clear, ISA and ISL. ISA means interest sensitive asset and ISL means interest sensitive liability. So again and again I will tell you this time, ISA, ISL, let's understand. So basically, let's look at the types of gap and their effect. Here you can see. So negative gap. What is the meaning of negative gap? When I say negative gap, just wait a minute. Yeah, now I hope it is visible. Now when I say negative gap, it means liability sensitive, right? So when it happen, when liability is greater than asset. Suppose in case liability exceed asset, this is called negative gap, right? This is the case. And there is something called positive gap. When positive gap happen, when asset sensitive, when asset is larger than liability, right? So what happened in the case of negative gap? What happened in the case of negative gap? When liability is larger than asset, then in this case, suppose interest rate rise. Try to understand, this is very important thing, right? Whenever there is a negative gap means liability sensitive, means liability exceed our asset, and in this case suppose rate increases, what will happen? Our NII will get decreased. This is very, very important thing, right? So if our asset is negative, if there is a negative gap, then in that case, if interest rate increase, NII will decrease. And if there is a positive gap, right, if there is a positive gap, which means asset sensitive, which means our asset is greater than liability, and if there is a rate decrease, our NII will get decreased, right? So rising interest rate increase NII, decreasing interest rate decrease NII. So everything happen fairly in the case of positive gap, but everything happen in the reverse order in the case of negative gap. That is the point, right? So this is how we do it. So basically this is called gap analysis, right? So we see the types of gap, whether it is negative gap, whether it is positive gap. If it is negative, then in rate and NII have reverse movement. They are inversely proportional. And if it is positive gap, then both have the same movement. So the question is, what is the limitation of gap analysis? Yes, it has limitation also. It assumes that uniform repricing. This gap analysis assume that repricing is uniform. It reduces precision. Yes, obviously, since we assume that repricing is uniform for assets and liability, obviously it reduces our precision. This is one of the major limitations of gap analysis. So what we are trying to do, in a single slide, I am providing you every kind of information that is required for your examination, right? So we have just seen the types of gap we have. Now we are discussing what are the limitations. First limitation, uniform repricing. Second limitation is that it ignores repricing variation. Yes, it ignores repricing variation across assets and liability, right? So it cannot fully capture interest rate risk complexity. Yes, it cannot fully capture. So whatever interest rate risk complexity we have is not fully captured by this gap analysis. So these are the limitation of this gap analysis. I hope that makes sense to you, right? So then the second method of this interest rate measurement technique we have is called repricing schedule. So this method classify assets and liability based on their maturity period, right? Different assets and liability have different maturity period. So what this method do, they classify assets and liability based on maturity as well as repricing period, right? So it offer a clear picture of the risk exposure. There are two things are there. First thing is called fixed repricing and the second thing is called non-fixed repricing, right? If we have fixed repricing, it means it align with your contractual maturity date, and if it is non-fixed repricing, then in that case it is based on management judgment and variable maturity. So question is why this repricing schedule? Because it help you to track cash flow mismatch, right? If there is any cash flow mismatch, you can track it easily using repricing schedule. And it identify period of high sensitivity to interest rate change. Yes, there might be some period where our assets is highly sensitive to interest rate change, and it enable our better asset liability management decision. So both gap analysis and repricing schedule plays a key role in measuring interest rate risk. While gap analysis provides a quick estimate of NII impact, repricing schedule offer a more detailed and structured risk assessment. I hope that makes sense to you, right? Every aspect we have just covered now. Now friends, let's switch our focus to the next topic that we have after this interest rate risk management. We have one more technique we have is called duration analysis. So interest rate change can significantly impact a bank economic value, and one of the most powerful tool to measure this is called duration analysis. So what is duration analysis? It is a core technique used to evaluate how change in interest rate affect the economic value of assets and liability. There is something called economic value of what? Assets and liability. So how this interest rate can affect this economic value, this can be better be analyzed using duration analysis. So there is something called modified duration. Try to understand. So modified duration estimate the percentage change in bond price for a small change in interest rate. What I am telling you, try to understand. Very, very important thing. One numerical question case study base is regularly asked based on calculating the modified duration. So you must know it, right? So modified duration, how do we calculate? So how do we calculate the modified duration? You know it very well that it estimates the percentage change in bond price, right, due to for a small change in interest rate. So this is the meaning of modified duration. Let me show you what it actually means. So interest rate delta change in interest rate, right, and for 1% interest rate change, how much our bond price change? What is the delta BP, right? Again I am repeating. So it measures delta BP. Delta BP means change in bond price. Because of what? Because of change in interest rate. Suppose our interest rate changed by 1 unit. So how much is the bond price changing? That is called modified duration, right? So the higher the duration, the more sensitive an assets or liability to the interest rate movement, right? And I hope you know how to find the modified duration formula. I hope summation of PI VI upon summation of PI, right? So so there is a separate lecture available on our channel regarding the calculation of the modified duration, right? So I will provide you the link of, if you want that link, please write yes in the comment section. I will provide the link of that video. Now friends, let's look at what are the factors affecting duration, right? So if you look at the factors affecting duration, so if the longer maturity is there, right, it means higher duration, right? Assets with longer maturity are more sensitive to rate change, remember. And coupon rate also impact. If coupon rate is lower, suppose coupon rate is lower, it means bond have higher duration than high coupon bond. So coupon rate decrease, so duration increase. And just now I told you maturity increase, then duration increase. This way these two factors affect duration, coupon rate and maturity. And yield also influence. You know how yield influence? As yield rise, duration decreases. So 3 factors I told you. The first factor which influence duration is maturity. If maturity is higher, duration is higher. Second factor I told you is coupon rate. If coupon rate is lower, duration is higher. Third factor is yield. If yield rise, duration gradually decrease. Where I means they are inversely proportional. So this duration is inversely proportional to yield. Now friends, how to bank use duration analysis? What is the application of it? So to assess portfolio risk and to project economic value. The first use of duration analysis. Second use can be to structure hedging strategy, and third use to align asset liability management strategy, that is called ALM. So bank don't just look at the today's profit, right? So basically what they do, they plan for long term. Duration analysis help them predict, prepare and protect against unexpected risks. Now let's look at the simulation approach. So friends, you know what is the meaning of simulation? So bank don't just react to interest rate change, they simulate different scenario to stay ahead, right? So different scenario they simulate. Let's explore the two powerful approach. The first is called static simulation and the second is called dynamic simulation. What is a static simulation? So it is a snapshot. Basically what happened, this method evaluate the cash flow based on the current balance sheet, right? So cash flow evaluation is done based on the current balance sheet, right? And interest rate scenario. So current balance sheet and interest rate scenario, based on this, what is done? Cash flow evaluation is done, right? So that is called a static simulation. And what are the methods which are used in static simulation? The first method is called yield curve shift. Static simulation. So this method evaluate cash flow based on the current balance sheet and interest rate scenario, right? And what are the methods? The first method is called yield curve shift, which means predicting how a change in interest rate affect asset value. And second is called spread change. Spread change means examining how the gap between lending and borrowing rate impact our earning, right? These are the two methods which are used. Again I am repeating, yield curve shift, which means how a change in interest rate affect asset value, and spread change means how the gap between lending and borrowing rate impact earning. There is something called present value analysis, right? So this one more thing, that limitation of a static simulation is that assumption risk is there, which means it assumes that balance sheet remain unchanged over the time, right? And there is something called this is the simulation approach, complete simulation approach limitation, assumption validity. That means it assumes that balance sheet remain unchanged over the time. And there is something called black box risk, which means complex model may hide risk within assumption. Second part, that is called dynamic simulation. Unlike a static simulation, this method considers future business strategy and behavioral factor. There are some key factors like rate change, like simulating the effect of risk rising or falling interest rate. Then we have loan and deposit pattern, which means predicting how customer will react to market change. Then we have reinvestment strategy, which means planning how bank reinvest maturing asset. What are the advantages of dynamic simulation? That it models realistic cash flow interaction over the time, and it captures both explicit as well as embedded option like loan repayment, deposit withdrawal, and it help in better decision and proactive risk strategy. So basically, simulation approach help bank anticipate risk before they happen, while a static simulation give a quick snapshot. Dynamic simulation provide a real world evolving risk assessment, making it a game changer in risk management, right? So these are the two approach of simulation approach, we call it, in the risk management. Now friends, let's look at some steps to control interest rate risk. In this particular table, everything will be clear. Let's understand. So interest rate fluctuation can impact a bank profitability, but the good news is that bank can control and manage the risk effectively. Let's explore the key strategy used to navigate interest rate change. First of all, the first point is adjusting the bank interest rate sensitivity. So bank manage risk by controlling the gap between RSA and RSA, that is rate sensitive asset and rate sensitive liability. If you can manage the gap, obviously your interest rate sensitivity will become easy. So basically, how to manage the tweak the gap based on interest rate expectation. So if there is an aggressive gap management technique, so suppose the rate rise, right? If the rate rise, then increase the gap by holding more rate sensitive asset. So if the rate is rising, what you do? You increase the gap. By how you can increase the gap? So basically the gap is what? RSA minus RSA. How you can increase it? By increasing this RSA, right? If you held more rate sensitive asset, this gap will automatically increase. This is called aggressive gap management. Or suppose the rate is falling. So if the rate is falling, what you will do? You will reduce this particular gap. How will you reduce it? If you reduce it by shifting to fixed rate asset. If you shift to fixed rate asset, obviously this will get reduced, and this automatically this entire factor will get reduced. So this is called aggressive gap management. And the second technique we have for management of this gap is called maturity strategy, which means aligning the maturity of assets and liability. Obviously, if the assets and liability maturity will be aligned, obviously the gap will become less. These are the two techniques. Now this is how we adjust managing gap. The second way to do it, right, is to balance sheet strategy. In the balance sheet strategy, first thing to do is to bank adjust their investment and lending portfolio to minimize risk, right? So if they want to reduce asset sensitivity, so what they do? How do they reduce their asset sensitivity? So first of all, they increase floating rate deposit, right? They increase floating rate deposit. like floating rate deposit means what? Those deposit with adjust with the rate change, or increase fixed rate lending. Increase fixed rate lending, or they increase floating rate deposit, or they extend investment portfolio maturity. All of these cause reducing asset sensitivity. And the second technique is to reduce liability sensitivity. How to reduce liability sensitivity? Either they reduce investment portfolio maturity, or they increase floating rate lending, or they increase long-term deposit. If you want to get detail, you can enroll in our course. I have provided in detailed explanation of how they do it. Since this is a smaller video, I can't provide you detail regarding it. So that's all you need from this particular topic. So I request you to please go to our numerical section, our quizzes section now, which I have added in today's crash course. You will get detail of questions, numericals, which can be expected from this particular topic in examination. So this is the beauty of the crash